Smith alongside Shauna Smith. This is Yahoo Finance's flagship show, The Morning Brief, brought to you by Invesco. Let's get to the three things you need to know today.
Good morning. Well, stock futures are higher as the Dow and S&P 500 rebound from their worst trading day in a month. And in the bond market, the 10-year yield pushing further above 4%, the highest level that we've seen in more than 2 months. Investors are repositioning ahead of the market's next big test. We've got September CPI print and the start of third quarter earnings.
That's right. We're also tracking Hurricane Milton barreling towards Florida's Gulf Coast, slowing to Category 4 strength overnight, but expected to return to Category 5 later today. The storm is also expected to weaken before making landfall Wednesday night. We're seeing reaction in the markets, insurance stocks mixed, seeing some big losses Monday. Meanwhile, backup power company Generac extending some gains this morning.
And PepsiCo cutting its revenue forecast as consumers pull back on spending, the latest sign of weakening demand. Pepsi is blaming the value-conscious consumer, rising geopolitical tensions, and product recalls for the disappointing outlook. Brent crude prices pulling back this morning, falling below the $80 mark and snapping a 5-day rally after China held back on additional stimulus today. Still, traders are watching for any escalation between Israel and Iran and how that may impact the commodity. However, our next guest potentially does not see prices remaining elevated for long. Joining us now, we want to bring in Christina Hooper, Invesco's chief global market strategist. And Christina, talk to us about this massive move higher that we saw in crude prices. Last week, they were up about 9%. We did see an additional move higher yesterday. Here we are today pulling back that spike that we've seen. Do you think it's going to be short-lived, and why or why not?
I do think it will be, because we've seen this before. Whenever we see Middle East tensions rise, and in particular what we saw last week was concern that Iran's oil industry would be bombed in some way, and that would, of course, limit production and, of course, increase prices. But that's happened before. We've seen spikes before where oil prices in the last over a year have gone up to above $90, and they've come down pretty swiftly because tensions have eased and investors took their, got a little less emotional and a little less worried. So I think that same thing could easily happen again. Yes, investors are walking on eggshells right now in terms of worrying about oil prices, but I think once we see some kind of de-escalation in tensions, that will likely dissipate.
And so with that in mind, is it a muted impact to inflation in this near-term period of time that we should expect?
So I don't think we're going to see any kind of significant impact. Of course, it really matters how long it stays elevated. But we also have to recognize there are other factors at work. For example, today, the prices come down because of concerns or recognition that there might not be as much demand coming from China because not as much stimulus seems to be forthcoming, at least right now. So I don't think that we're going to have it elevated for long. But yes, the longer it's elevated, then it works itself into the system, although it takes a while to make its way into core inflation, which is what the Fed is focused on.
So, Christina, how should investors then who are out there be looking at this? Because we've seen this spike higher in crude, and then when you take a look at some of the other commodity trades, precious metals, you've got this move higher in gold. Is that a trade that you think makes sense at this point? And I guess why or why not?
I do think gold makes sense for a lot of investors right now because they're using it as a geopolitical risk hedge. And I think of it as enabling them to then also be risk on in other parts of their portfolio. Whereas you might have seen in the past investors become fully risk off, so long as they feel they have adequate geopolitical risk hedges, whatever they might be, but today their go-to safe haven asset class is often gold. That enables them to have a broadly diversified portfolio and still participate in equities and other areas of the market that offer significant capital appreciation potential. So I think it's healthy. And of course, while prices are high for gold, the opportunity cost of owning gold goes down as rates go down. So that's a positive as well. It is a non-yielding asset class. So I do think investors need to be well diversified, looking at other geopolitical risk hedges as well, possibly, but just be well diversified in their portfolio.
You mentioned capital appreciation and some of those opportunities within equities. Where is that top opportunity from your perspective right now?
So I see opportunity in U.S. equities. I mean, if we look at the overall valuation, it's high. But if we dive down, there are a few names in the S&P 500 responsible for a significant amount of that high PE ratio.
Let me guess, is it 7 of them?
Close to 7, around that amount. And then there's another, let's say, 493 or so that have lower valuations. And by the way, many are experiencing accelerated earnings right now. So I think that's an area of opportunity. I'm really excited about UK equities.
Interesting.
Valuations are screaming very low right now. Now, sentiment has been negative recently, consumer sentiment, because of concerns around the autumn budget, which is getting released at the end of the month. But I think investors should take a sniff. You're getting paid to wait because it's a high dividend yield, well above 3.5% on the MSCI UK index. And I do think that once we get past the budget and the Bank of England continues to ease, those are catalysts that could very well move UK equities higher.
Christine, that's an interesting international play for so many investors out there who are looking for new opportunities. I'm curious, though, just bringing it back here to the U.S. and that move higher that we've seen in the bond market with yields now, the 10-year yield holding above 4%. I think so many investors out there are trying to figure out exactly what this means for the move higher in equities and at what level does this become a bit problematic. What do you think?
So I think we are going to see some fluctuations in Treasury yields. That reflects uncertainty around the economy and the Fed. Let's face it, many investors were surprised over the last 2 weeks. We saw a stronger U.S. economy than I think even the Fed expected. We saw a blowout jobs report. And we have to worry a little bit because average hourly earnings has crept up now for the last 2 months. So we're now at a 4 handle again, 4% year over year. We also have seen really strong PMIs. Markets were shaken when we got the services PMI last week, and it showed that new orders had gone up very significantly. So this is a hotter economy, and as a result, I think that investors are recalibrating their expectations around the Fed's recalibration of monetary policy. And that to me means that we're going to see a 10-year yield that's going to fluctuate between probably 3.8, 3.7%, and 4%, maybe a little higher. And that's to be expected in this fall period of pretty significant uncertainty.
Invesco Chief Global Market Strategist, Christina Hooper. Great to see you. Thanks for joining us this Sept. Absolutely. Well, Category 4 Hurricane Milton is barreling towards Florida and is expected to make landfall on Wednesday. The last devastating storm to hit the U.S. was Helene. Damages from that Category 4 storm might cost over $30 billion, according to analysis by CoreLogic. And its impact on the jobs market and the economy in the southeastern part of the country is still yet to be seen.
To discuss the storm's potential impact, we want to bring in Dana Peterson, the Conference Board's chief economist. Dana, it's great to have you. So we're trying to figure out exactly the impact here, the economic impact, aside from what is most important here in terms of the health and safety of so many of those who will be and ultimately, unfortunately, will be affected by this storm. But zeroing in on the economic impact of this storm, what should investors be thinking about just in terms of the potential disruption or looming effects this could have on the economy and ultimately the labor market?
Absolutely. Certainly, initially when the storm hits, it's very damaging and costs a lot of destruction and also disruption in terms of employment. But over time, some of those costs can be offset by rebuilding. Now, when we look at the amount of money that hurricanes have caused from 1980 through 2023, damages were upwards of $2.6 trillion. That's roughly $60 billion a year. So imagine that as a share of GDP, and it's like 0.2%, but it could potentially cut anywhere from up to 0.3 off of GDP after the event. However, a lot of that can potentially be offset by rebuilding, but nonetheless, it's highly disruptive. And when we look at the storms that have been coming through, they've been impacting large swaths of the labor market.
And when we think about that, what are the sectors within the labor market that tend to see the biggest impact as a result of these storms and the severity that we've seen to this juncture in the hurricane season?
Sure. Anything that heavily relies on infrastructure. So, for example, ports being closed or bridges and roads being washed out, that affects transportation. Also, while there's downside there's also potential upside, certainly for grocers who, people go and they buy food, and also home repair types of companies that provide the materials not only for preparation for the storm, but also for after rebuilding.
Dana, to what degree does an event like this, past hurricanes, does that complicate maybe the interpretation of this economic data and potentially, I guess, cause an overhang here within the data?
Yes, certainly immediately you do see that economic impact. It also affects insurance costs. And we know that many insurers, home insurers, are either raising premiums or moving out of areas that have been subject to a lot of natural disasters. So you have these second and third round effects that may not be completely offset by the ultimate rebuilding that must happen to replace infrastructure, goods that have been destroyed, homes that have been destroyed, and items that have been lost.
Dana, what's the timeline of the distorted data or the impact of the data that hurricanes of this magnitude could cause?
Sure. I mean, usually you'll see the impact within a month and consequently within the quarter. It also depends on where the hurricane lands and where in a particular state the hurricane affects. So if it's in rural areas that are sparsely populated, or in areas where there aren't a lot of people or businesses, then the damages can be less so, as opposed if it barrels through a major metropolitan area. So you'll tend to see those effects certainly very immediately on the ground, and then it'll show up in the data within the month or even a quarter. But certainly when we look at payrolls, we could see some effects, certainly from last week's Hurricane Helene, which impacted at least 3 states, and also the Hurricane Milton that's headed for Florida.
Dana, kind of sans hurricane, just for a hot second here, or even kind of beyond the effects of that, more broadly, as I was taking a look through the Conference Board Employment Trends Index that actually decreased in September, I wonder how you would describe the labor market as a whole, especially as we're moving towards the November meeting for the Fed. I mean, of course, chronological order, of course, we're moving towards it. But at the end of the day, that's going to be a different type of conversation, it seems, when you have a higher than expected jobs report that just came out for the most recent month that they're also going to have to evaluate, especially as it relates to their own Fed policy pathway.
Sure. We've been looking at the data over the last few months, and our sense is that the U.S. labor market is fine. Yes, payrolls are not 200,000 a month. We don't need that. Certainly when you're at full employment, which is where I think we are. The unemployment rate ticked back down, and even the uptick we saw was really related to kind of temporary factors. And the natural rate of unemployment is probably around 4.5%. So at 4.1%, we're fine. And certainly heading into the November Fed meeting, I think the Fed can probably go 25 basis points again, because they have been saying the labor market right now is solid. And really that 50 basis points of cuts was kind of insurance to make sure that we didn't see realization of any downside risks to the labor market. But there was never any indication that, or at least from the Fed, that, the labor market was in trouble. So I think that, heading into the meeting, the labor market is fine. Yes, we may see some impacts from the hurricane, but the Fed is certainly going to look through those impacts.
All right, Dana Peterson, thanks so much for hopping on with us here this morning, the Conference Board's chief economist. Thanks, Dana.
Thank you.
Well, coming up, we'll have a continued coverage of Hurricane Milton, bringing you the latest headlines and taking a look at the potential economic damage of the storm. Plus, we'll count you down to the opening bell on Wall Street as traders look ahead to this week's CPI data and earnings. We'll break down Pepsi's earnings as the company cuts its outlook after an unexpected decline in summer sales, the latest sign of a weakening consumer. We've got all that and more coming up on Morning Brief.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Now time for some of today's trending tickers. You can scan the QR code to track the best and worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, let's take a look at Honeywell announcing plans to spin off its advanced materials division by early 2026. This is according to a statement from the company as well that they've published here. The business could reportedly be worth more than $10 billion on its own and is on track to bring in about 10% of Honeywell's overall revenue this year. The move is part of the CEO's plan to focus on the three core trends of aviation, automation, and energy transition. Shares right now are up by about 2.5%. We have a statement as per the press release from the company from the CEO, Vimal Kapur, who has said essentially this would be a sustained market demand for, or it's actually driven by the sustained market demand for advanced specialty chemicals and materials around the globe. Confident now that this is the right time for the business to grow independently and leveraging some of those technologies to deepen customer relationships. Also, they think this is going to unlock the next leg of further value for shareholders as well.
Yeah, we'll see whether or not that comes to fruition, but you're exactly right. This has very much been communicated from management just in terms of how they are aligning their priorities for Honeywell going forward, very much focusing on three sectors of their business: aviation, automation, and energy transition. Just in terms of how much they could potentially get here from this spinoff, the advanced materials business could be worth more than $10 billion. That's according to the journal's report that broke this story. The materials business on track for this year's revenue of around $3.8 billion. That's about 10% of the total here for Honeywell. The division's product range from Solstice brand refrigerants to industrial solvents and additives, just give you a sense really of that business and the importance there of that business. But again, the fact that Honeywell is looking to streamline its business, streamline its costs, seeking that potentially this could be a good opportunity for them to spin off their business. And again, the journal estimating that it could be worth more than $10 billion. Let's get to a top trending ticker, the top trending ticker on Yahoo Finance this morning, and that's Supermicro Computer, saying that it's currently shipping more than 100,000 graphic processing units, GPUs, per quarter as demand for AI continues to surge. The company also unveiling new cooling products to help servers operate more efficiently in AI factories. We're seeing a big move to the upside here in extended trading, up about 7%. This comes after the massive move to the upside yesterday. I was looking at the quick street reaction here this morning. Investors very positive on essentially what this signals just in terms of demand and a healthy demand here going forward for that AI story. We talked a lot about some of the past results that we've gotten, or even updates from companies. Micron comes to mind just in terms of what that did to reignite this AI-fueled rally. Now, Supermicro, very company-specific just in terms of some of the issues that has been circling Supermicro most recently, still waiting for the filing there and the probe coming into the company following the report from short seller Hindenburg Research. But again, the stock moving to the upside today. But if you take a look at that longer term chart here, it's still well off about 50% since peaking in March.
Yeah, I'm old enough to remember last month in September when Needham had called this the coolest kid in AI town, their words from the analyst over there. And no doubt that's translating through to at least how customers and some of their clients are potentially thinking about adding on to their orders. And that's a good thing for Supermicro as of right now. Right now, it seems like they're shipping more than 100,000 graphics processors per quarter. And this comes back to also how they're going to be able to play within this data center as well. Liquid cooling products as well. That's going to be really key for making sure that you don't have just a bunch of overheated, supercharged data centers at the end of the day. And I think Supermicro it just plays right into their hand on that front. So we'll see what more they're able to kind of add on as this boom continues to really make its presence known in the equities landscape for some of the generative AI chip demand that we've seen thus far. Finally here, we've got to talk about booze. European beverage makers taking a hit after China said it would impose tariffs on brandy imported from the EU, not to be confused with the 2000s and 90s R&B singer. The tariffs are set to take effect on Friday, ranging from 30 to 39%. And this comes after the EU imposed tariffs on Chinese electric vehicles. So you could sum this up as a tit for tat, essentially, but there you're seeing some of the moves from the European beverage makers, unfortunately, moving lower in reaction to this. French President Emmanuel Macron, I was like merging them together like a Brangelina almost, but French President Emmanuel Macron essentially calling this pure retaliation, even when they had started the investigation China had into some of the brandy operators and the brandy probe that they had initiated as well.
Yeah, and I think that this was the exact fear from so many within the EU bloc when it comes down to the vote that we got most recently on the tariffs on Chinese cars. There was a lot of talk just about what exactly this could set off in terms of a tit for tat, a tariff war, and it seems like at least this could be the start of that, and you could see the real impact on these stocks here this morning under pressure here in early trading. And you take into account some of that move here to the downside that you could see going forward. Lots of questions about what ultimately this is going to do for pricing, obviously, the impact that it's going to have on consumers, what this means for demand down the road for so many of these companies. So again, a very, very pressing issue, an important one to watch. And then also just when you draw some parallels to what's happened here in the U.S. And you talk about some of that rhetoric from both candidates here for president, from former President Trump and also Vice President Kamala Harris, just talking about their plans with China and very much both taking a hard stance, it seems like, for China and their potential policy were their administration to be elected. So again, this could be a warning sign for maybe more of what is to come here. And we know we have seen plenty of a back and forth between the U.S. and China here over the last several years.
Yeah, for anybody wondering if this is a big deal or not, I mean, kind of. All right, at the end of the day, like, French and France specifically, their shipments to China, it totals around $1.7 billion, at least it did in 2023 here. 99% of China's imports of the spirit here. So that is some of the context and why perhaps China targeted this specifically. But then you think about how it compares even to what was already put on the table with regard to the tariffs for EVs. Now, let's also keep in mind in the backdrop, there has been so much more of a mind share shift among the Chinese consumer to some of the homegrown options within the EV landscape, largely because there have been some amazingly lucrative subsidies that have been put on the table to spur demand within that market as well. So, yeah, there are going to be a couple people who are not going to be able to get the same type of happy hour drink for the same price in those regions. But at the end of the day, we'll see if there is any reversal of this tit for tat and when people can expect the brandy to cost just a little bit less in the region.
All right, we'll keep right here on Yahoo Finance. Much more coming up next. We've got the opening bell on Wall Street. We'll be right back.
Are you a passionate investing bull? Maybe love scooping up shares of NVIDIA on every single dip because, well, AI is changing the game. Fascinated by PE ratios and how the presidential election outcome may impact them? Then come one and come all to the 2024 Invest Conference. Huge power players all under one roof. Thought-provoking discussions on November 12th at Second in New York City. We can't wait to welcome you to Invest 2024 live at Yahoo Finance all day.
Getting ready for the opening bell on Wall Street. You can see the excitement playing out at the NASDAQ and the New York Stock Exchange. Again, futures pointing to gains here at the open. All three of the major averages on track to open the trading day in the green. A bit of a reversal from yesterday's downward pressure where we saw the worst performance for the Dow and the S&P in just about a month. But it's a new day. And you can see lots of smiles on the floor of the stock exchange, and hopefully those smiles will carry over into the market here this morning. When you take a look at the major averages, and this report brought to you by Invesco, let's take a look at the three major averages as we wait for the NASDAQ to open. You've got the Dow and the S&P both trading to the upside here above the flat line. The Dow up almost 100 here. You have the S&P up just about 0.5% as we wait for the NASDAQ there to calibrate. Let's kick it over here to the heat map and some of the activity that we're seeing play out on a sector basis. You are seeing a lot of green on the screen. You've got technology leading the way. That sector up just about 0.6%. Consumer discretionary, at least for now as we wait for it there. You got financials up about 0.6%. Consumer discretionary also among the outperformers there. On the flip side, materials and energy under a bit of pressure. Taking a look at some of the outperformance that we're seeing within big tech and taking a look at some of those bigger tech names. You got NVIDIA up once again today, up just about 1.5%. Some of those other larger cap tech names outside of Microsoft also moving to the upside. Tesla up just about 1.7% ahead of its robo-taxi day. That's coming later on this week. And then we're expecting to hear some announcements from Google in terms of their remedies regarding the antitrust case. That stock is up just about 0.6% ahead of those developments. I also want to point out some of that flip side on some of the pressure that we're seeing in Chinese stocks today. A very, very different story, but at least up until right now in very, very early trading, we are seeing U.S. stocks being able to shake off some of those concerns. But again, you've got big names like Alibaba, Pinduoduo, JD.com moving to the downside today. You got JD.com off just about 8% here at the open. Jared Blickery standing by for a closer look at some of the other movers. Jared.
Thank you, Shauna. Well, I'm looking at the S&P 500. This is kind of like my guiding light, and I'm going to pull this up here with a 6-month chart. Basically, we have exceeded the prior highs, and we've just been trading in a range for the last few weeks, about 3 or so. And as long as we don't breach these highs right here, which are just under 5,700, the risk rally is still on, even though I'm seeing some yellow and flashing orange warning lights. So let's take a look here at the 10-year, because that has been really on fire recently. That's a 6-month chart. I'll dial this down to a 3-month so you can see the rally. This happened last week on the non-farm payrolls, that big jump right there. And so that's given me a little bit of concern because higher rates, especially when they move very fast, often cause a headache for equities. I just want to show you the VIX that has kind of rallied into prior resistance right here, but it's not going any higher. Higher VIX means lower equities, but it's contained for now. And let's check out the sector action. It's kind of the mirror image of what we've seen before. Tech and energy swapping spots. One of them's the leader, one of them the lagger. And today, financials are actually now the leader. Tech is taking the 3rd seat or 4th seat, but energy is definitely moving to the downside. And that is on the biggest decline in crude oil that we've seen in 4 weeks. So here's our commodities heat map. You're going to see a lot of red there. Cocoa in the upper left, that's up 3.7%. But down here, we have crude oil down about almost 3%. When you take it into consideration, I'm going to show you a 3-month chart with some candlesticks here. The monster rally that we've had over the prior 2 weeks, it's not the biggest deal, but I do look at strong rejections like that. So maybe the energy rally needs to pause for a little bit. The analysis of China is really interesting here. I'm just going to show that real quickly again, because you see the sea of red here. Let me show you on a 1-month basis. These stocks are still sitting on a lot of highs, but coming back after a holiday, a lot of people thought that we would see more upside action, and instead we're seeing this. Got to close with Bitcoin here and crypto. I was looking at MasterStrategy, and let's see if I can find MSTR. It just broke out of a range, and now it is at the highest level that we've seen in a while. Here's is a year-to-date chart, and you can see there are those all-time highs. So MicroStrategy has been a leader in the past, and we'll see if it can do it again.
Jared, thanks so much. Really appreciate it. A lot of things to track, especially as we begin this new trading session. Yahoo Finance's own Jared Blickery. Well, let's hone in on the micro picture and get a look at what stocks investors should be bullish on or bearish on, according to our next guest. Joining us now, we've got JJ Kinahan, who is the CEO of IG North America. JJ, great to have you back on the program with us. Let's talk about that. I mean, as we're squarely looking into what is going to be another kind of firework-filled earnings season potentially, where are some of the most bullish and most bearish names that you've got on your list?
Yeah, so, I'll talk about what our clients are doing through our Tasty Trade platform. It's really interesting to me. The number one bullish stock over the last week has actually been CrowdStrike. That is one that when I looked, I was like, you got to be kidding me. But again, talk about a stock where perhaps all the bad news is out. At the end of the day, they still have these contracts. Now, they had a tough time signing some new contracts. There's no question about that. But I think the general belief is this bad news is built in. So it's a stock that may make sense for many people to take a chance on as we head into the fall season. So, and they have rolled out some new products, et cetera. So again, by far the most surprising thing I've seen. The next two make a little more sense to me. Microsoft, and the reason Microsoft happens is we've seen now for 4 years running, when there is problems in the market, the stocks that people ran to for the longest time was Microsoft and NVIDIA, Microsoft and Apple in terms of confidence. Then it went to Microsoft and NVIDIA. And don't forget, as you reported last week, we had a pretty good sell-off. Yesterday, a pretty good sell-off. Now it just seems to be Microsoft sort of standing alone a little bit. It really is the bastion of safety outside the indices from the retail investor. So it's really interesting that pretty much for the last 4 years, every time we start to go down, that's the stock that people turn to for a condition of safety, if you will. And then the last one, Coca-Cola, this is I think that they got a lot of respect in the industry, if you will, with the fact that they had that spicy drink, clearly was not hitting well with clients. And so they immediately cancel it. And, you talked a little bit earlier about maybe happy hour drinks are a little more expensive. Well, they came out with the Bacardi and rum and Coke partnership here. So we'll see if that becomes a quick staple of the happy hour.
JJ, what about the warning, though, that we got from PepsiCo this morning, the fact that they did say that weakening consumer? Are you looking at that as a headwind here, not only for a name like Coca-Cola, but more broadly, the consumer staples sector?
I think that where you're going to see it, yes, I think it's something, Shauna, you have to be aware of. But that I looked to the other side of the ledger, if you will, for what our clients sold. And one of the stocks I see leading the way there is Target. And so that's, obviously a very mainstream, people go to shop there all the time. And that's one of the leading stocks that people have been bearish on. So that one makes things a little bit interesting to me. And also from the consumer side, not necessarily a staple, but certainly a stock that's had actually, I think maybe surprisingly to many of us, had a really impressive run over the last month and a half, being UAL. And that is also one, I think it's a combination of two things there. Some people taking profits, and also people saying, the travel sector, we have weather. Obviously, you guys are reporting on some of the weather things going on right now. If the consumer really is as strong, the employment report, we have CPI, PPI next couple of days. We get to see a little bit more of that. So I think that plays into exactly what you're asking about, Shauna. So I think what's happening is they're being a bit more selective in the stocks, but Pepsi's questioning may be good for Coca-Cola in the long run.
What do you think the theme is that prevails this earnings season, JJ, especially as we have been talking about this focus on the consumer?
Yeah, I think the two big things we're going to want to hear starting this Friday with the financials and going into the next two main areas. A, is the consumer going to continue to spend money? B, what's the outlook for housing? I think those are obviously interest rates, et cetera, everybody's going to talk about. But in terms of what the individual companies are delivering, what the CEOs need to talk about. And by the way, I think that this is always one of the most interesting earnings seasons, the fourth quarter. As we head into the fourth quarter, the reason being they're going to talk about what happened in Q3. But at this time of year, one of the things everybody's doing is planning for next year. So you're also getting an insight into what the CEOs should be thinking for the following year and how they're planning. So again, I want to hear what they are thinking about in terms of the consumer health overall. We'll get a big, speech on that, I would assume, from the CEO speaking this Friday and early next week. And again, they're also going to give us some insight into what the housing market looks like and what their interest rate predictions are going forward and how they're going to affect it. Because again, you guys living in New York City, I don't have to tell you how crazy rents are and how is that affecting people as well as the price of housing itself.
You certainly don't. We know that we're all too familiar with that trend. All right, JJ Kinahan, always great to have you. Thanks so much for joining us here this morning.
Thanks. Have a great day, guys.
You too. Tech companies are scrambling for energy sources to power data centers amid the rapid growth of AI and its energy demand. That's boosted utility stocks this year to be the third best performing sector on the S&P 500. For more, let's bring in Catalyst co-host Madison Mills, and she's got our chart of the day. Maddie.
Thanks so much, Shauna. So I want to pull up a map of the United States. This is from Torsten Slock over at Apollo here. Now, when you take a look at this map, you can see this is Virginia here at the deepest purple that you can see on your screen. And that is because data centers use a whopping 26% of Virginia's total power consumption. So that is a very significant increase there. And you can see kind of some swaths across the country where data centers are taking up more of the power pie. The reason we look at this, right, is because amid the AI boom that you were mentioning, Shauna, we are seeing these data centers that are required for storing things like our data, like cloud computing software. And those data centers require a ton of energy in order to operate. And there are questions about how we are going to complete our clean energy goals moving forward, as we do need more of this energy, and also questions about what fiscal spending and infrastructure is going to look like amid that AI boom. But in terms of the market impact, this is leading to a big boon for utility stocks. And as you mentioned, that is why we're seeing utilities as the third biggest performer in the S&P 500. Our own Julie Hyman spoke with Anthony Crowdwell over at Mizuho about how data centers could increase load growth, and that leads to additional security and electricity being sold each year, which is a boon for utilities. Let's take a listen.
I think their load growth for the last 10 years was somewhere between 0.5%.
Wow.
So efficiencies, we have these LED lightings, we have these sensors that turn off the lights in our office as soon as we leave. That's really weighed down on the number of units that a utility sells. All of a sudden, bam, what happens? We get a pandemic, we get a lot of relocation going on to the communities like Phoenix, Arizona, and then we get this great tailwind of data centers, this onshore of manufacturing, and all that is helping utilities in certain locations sell a lot more units.
So I thought he laid that out really well, this idea that we had all installed light bulbs that turned off when we exited our offices. That led to a decrease, a headwind for load growth. But now we've got data centers filling in the gaps there. And just some context for users, when you're utilizing something like ChatGPT, that utilizes at least 10 times the amount of energy as Google search. And that is part of why we are seeing this increased need for power and, of course, data centers across the country as well, Shauna.
There's so much to do to explore this story. I know we have a ton of angles coming up. Maddie, you've been all over it. Maddie, great chart of the day. Thanks so much for breaking that down for us. Coming up next, we will be taking a closer look at Pepsi. Our very own Brian Zazi speaking with the CEO about its most recent quarter. We've got that for you coming up next. Welcome back to Morning Brief, brought to you by Invesco. Several years of high inflation is still an issue, and it's impacting the business of snacks. Shares of PepsiCo are falling this morning after missing revenue expectations and trimming its full-year guidance. Yahoo Finance executive editor Brian Sozzi got the chance to speak with PepsiCo's chairman and CEO Ramon Laguarta on the latest quarter. Sozzi just hopped off the phone a few minutes ago. What did you hear?
Yeah, I did just hop off the phone. Doing that work today, Shauna. Earnings season has started, and Pepsi earnings are kicking this off. It's no more Alcoa. It is PepsiCo. So I think investors are seeing a little bit of a reversal in shares of PepsiCo. I'm here to hopefully help you make sense of what you are seeing with 4 top takeaways. You see a lot of consumers enjoying muscle milk, which is now owned by PepsiCo. First up, snack inflation. Snackflation, as I call it, is still very much a problem. Ramon told me on the phone. Now, this is as a result of a lot of packaged food companies having raised prices during the pandemic, and a lot of those prices for potato chips, pretzels, Tostitos, you name it. And it's not just a PepsiCo thing. These prices are still staying high. That's where I think you're going to see PepsiCo really go out there and market very aggressively. Lower prices around the Super Bowl, most notably, Ramon told me. Cost cuts are in the cards. Coming up at PepsiCo, this is a company that had always cut costs. I think you're going to really see them drill down and find new ways to cut costs, especially around automation to improve their margins with sales a little bit under pressure. I think why you're seeing the earnings, or the stock price, I should say, this morning reverse compared to initially it being down. Earnings, the company still reaffirmed its outlook for earnings this year, up about 8%. I think that's in part because they're going to be out here cutting costs to help support that bottom line. Also, PepsiCo, historically a very aggressive buyer of its stock. And then I did ask Ramon about some chirpings returning to Wall Street about the need for PepsiCo to break up. Of course, this is a beverage business and a snacks business that owns Frito-Lay. They also own Quaker Foods. Ramon saying that is not in the cards, not something they're looking at. This is has always been a point of contention with many analysts on the street. Ramon saying, no, we're not going down that route. And then I mentioned a lot of pressure on the consumer here, and I thought this quote from Ramon was very interesting. He's saying we see that the consumer is very challenged and that the consumer is making a lot of decisions. They're optimizing their full budget, and they're also, so they might be cutting on food to pay for their subscriptions, interesting, or they might be cutting on food to go see movies on the weekend, and really there's a lot of trade-offs they're making when it comes to food. So you may go to the supermarket, you may see that $5 bag of chips for a lot of households out there that is still very much an expensive purchase. And Shauna, I know you might like this, but I did have a new picture here of a new Frito-Lay offering, some new spicy chips. That maybe, to me, seems like an affordable purchase. I'm excited to try them because why not? I'm all about product innovation in food.
I'm all about product innovation of food, especially when it comes to chips. I'm always game to try new products. Saz, I'm curious just to get your perspective, though. We were looking to this earnings season, very, very early in the earnings season. Pepsi really giving us this first look here about whether or not, though, we were going to see some of these consumer staples names regain momentum. Do you think that kind of quiets or eases some of the expectations there? Maybe this quarter isn't going to live up to some of those lofty expectations, and that we would have potentially seen that rebound in the consumer.
I love that you asked me the tough questions, and really good chart here. Let me break down what you are in fact seeing. Really, PepsiCo shares have been underperforming the broader market this year. You see Coca-Cola, its longtime rival, those shares are doing well. Simple reason why. Coca-Cola is just a beverage business, and we're seeing beverage sales continue to be strong. Coca-Cola's first half of the year, very strong. PepsiCo's results being held back by the snacks business like we saw today. So investors are rewarding Coca-Cola, not rewarding PepsiCo. But both of these stocks are not doing relatively great versus the S&P 500. And to your point or question, Shauna, it's a really hard case to be made that you're going to see a reacceleration in packaged food volumes and acceleration in packaged food earnings for the balance of this year, in large part because inflation is still a thing and consumers are still challenged.
All right, Saz, great stuff. Thanks so much for bringing us the latest commentary there from Pepsi. We want to get into a deeper dive into PepsiCo's latest results, and we're joined now by Brian Spillane. He's Bank of America Securities Senior Consumer Goods Analyst. Brian, it's great to have you. We just heard from Sazzi rattling through the top numbers here from Pepsi, and he pointed it out right off the bat. Just in terms of the stock's reaction here today, we are seeing this move higher despite some of those worrisome headlines. I'm curious from your perspective, because I know you kept that buy rating on the stock. Why aren't you worried about some of that downward trends that we are seeing in terms of demand?
Yeah, good morning. I think that, and I think in the prior segment, Brian hit it right on the head, right? The stock has already underperformed the market. Actually, and I think part of the reason why the stock has reversed this morning is largely what happened. Pepsi's results was more or less priced into the stock. We could see the data all summer. Frito started mid-June to mid-July with a recovery, and then it tailed off over the course of the rest of the summer. And same with the data that you could see in Quaker and in the beverage business. So on one hand, things are still soft. On the other hand, it's somewhat priced in. That's part of the valuation gap to Coke. And so I think, hedge funds that might have been short this stock going into today's earnings, the event has happened, and I think some folks are probably moving on.
Brian, when it comes to shrinkflation, and this has been a focus here over the last couple of quarters, and I bring that up on the heels of the renewed pressure that we're seeing from some lawmakers, including Senator Warren, how big of an overhang, how big of an issue do you view shrinkflation for Pepsi?
It's broad,
yeah.
Right? And maybe for some context, this selling less for more, right, is a strategy that is, or a tactic that has worked very well for consumer packaged goods companies across emerging markets. It's a great way to manage inflation, and it has been in play across food and beverages really for most of the last 10 years. It's intensified more recently because of the really increase in cost inflation, and I think when you get to Pepsi, they've probably pushed it too far, especially in salty snacks. Where, even when you go into a convenience store, the price point has moved pretty high. There's going to be an adjustment period for sure, and it's happening now. But I would push back on the notion that it's going to reverse meaningfully, at least in the near term.
Brian, is there anything more broadly speaking that we can gather from these results, just in terms of the fact that maybe the consumer isn't as strong as we initially thought they were at this point? Maybe consumer staple stocks aren't going to regain some of that lost momentum. Maybe it puts them at a disadvantage versus some of their discretionary peers this earnings season. I know it's just one report, but is there anything that you're taking from this report that you think can be a common thread this earnings season?
Yeah, and I was following on to your discussion with Brian earlier. Expectations for a rebound in volume growth in the third quarter, I think, pretty much evaporated as we got to this point. So Pepsi's probably more confirms that bias as opposed to telling us something that maybe we didn't know. And I think the consumer has, is managing their whole budget differently in response to not just the cost of food prices going up, but it's everything from rents to homeowners insurance. One of the things we've been really focused on in our research over the last few weeks is impulsivity. And, we see a meaningful difference in the volume declines in the convenience and gas stations, which is, much more impulse purchase. But even when we're in the large format sort of food stores, deep price promotions are working, but a sort of normal discount with a product on display or promotion really isn't driving a lift. And again, that's typically an impulse purchase, kind of shopping off the shopping list. So it's not that consumers aren't buying food and beverages anymore, but they're really scrutinizing whether they need or are buying things that were maybe off the list when they walked into the store.
Value-conscious consumer, maybe a theme that we're going to hear about this earnings season once again. Brian Spillane, always great to have you. Thanks so much for taking the time to join us here. BofA Securities, a senior consumer goods analyst. Thanks so much.
Thank you.
Coming up, we're taking a look at some of today's top trending stocks on Yahoo Finance and breaking down why they're on the move. We've got that for you next.
You're watching The Morning Brief, brought to you by Invesco. We're taking a closer look at Yahoo Finance's trending tickers. We've got Roblox, Hershey, and Samsung. And we're doing it in 30 seconds or less each, or we're going to try. Roblox shares, they're plunging right now. Hindenburg Research taking a short position in the gaming platform. The firm claiming Roblox's metrics are, quote, wildly inflated, their words, not mine, and the platform poses major reputational risks for advertisers. Now, Roblox did not immediately return requests for comment from Yahoo, but you're taking a look at reaction to this. Of course, Hindenburg, one of the more famed short report publishers out there, and so a typical move that you see after a report like this gets published, shares are down by about 6% right now.
All right, let's move on to Hershey. Shares are on the move here today. UBS Securities downgrading the chocolate maker to neutral from buy, slashing its price target. The firm citing high cocoa prices compressing gross margins as a reason for that call. You're looking to move slightly lower here, off just about 0.1%. When you take a look at some of the other factors that are driving demand for Hershey, there was an interesting call out from Bernstein that also got my attention. Bernstein saying that GLP-1 usage is also going to impact the demand here for chocolate, saying that they expect the U.S. chocolate category may experience a 2 to 3% volume headwind to consumption from GLP-1 uptake. So again, as we monitor the fallout, or some benefiting from GLP-1 usage, exactly these types of companies, potentially what analysts are arguing, could take the hit as a result.
I mean, that weight is just falling out.
The weight's falling out for some.
Yep, exactly. All right, let's talk a little Samsung here on the day. Samsung Electronics warning its third quarter profit will come in below expectations. The tech giant issuing a rare apology for the performance, which it blames on both competition and delays delivering its high bandwidth memory chips to NVIDIA. Now here taking a look at shares actually moving lower by a little over 1% as of right now. I was doing some quick math as well here on the consolidated sales that was part of this earnings guidance for the third quarter of 2024. $58.6 billion is the U.S. equivalent of the 79 trillion Korean won that is anticipated here. So that is part of the update here that we got from Samsung, but certainly investors pricing this in today.
All right, coming up, we are going to be diving into an under-the-radar market indicator that one strategist says investors should be watching very closely. We've got that for you next, coming up on Catalyst.
It's a jam-packed hour focusing on the biggest movers and shakers on Wall Street.
This is market domination, and here, every day is game day.
We have 1 hour left until the market close.
It's game time for investors to make their final plays.
The clock is ticking, and we've got you covered with our quarter-by-quarter playbook.
We're bringing you in on all the market action.
With step-by-step analysis of our biggest trending tickers.
And expert insight into the day's biggest headlines.
We'll bring you the closing bell and get you to the finish line.
This is Market Domination.
Tune in daily from 3 to 4 p.m. Eastern.
Are you ready to master the markets and, dare I say, become a better leader in the process? Well, Yahoo Finance has you covered with our new full suite of original podcast content. Whether you're a seasoned investor or you're just starting your financial journey, we offer invaluable market insights and strategies to help boost your portfolio, build your wealth, and make you a successful investor. Now let's make some money and get a lot smarter.
I've done Yahoo Finance forever. This is a spectacular spot.
Welcome to Stocks in Translation. I'm your host, Jared Blickery.
Hello, world. I'm Ross Mack.
Hi, I'm Bob Powell, and welcome to Decoding Retirement.
Welcome to Living Not So Fabulously.
Hey, it's me, Tiffany the Budgetnista, your favorite financial educator. Welcome to Capital Gains World for a few days and everything has changed.
From Wall Street to Main Street to the C-suite, we are your daily lifeline because behind every great investor is Yahoo Finance. Join us on yahoofinance.com, the Yahoo Finance app, or wherever you get your podcasts.
Welcome back to Catalyst. I'm Shauna Smith alongside Madison Mills. 30 minutes into the trading day. Let's see the three catalysts driving the markets here this hour.
First up, investors look ahead to the latest read on inflation and the kickoff of third quarter earnings season as the market's holding steady with Treasury yields still above 4%. We'll get you prepared for those upcoming catalysts.
Plus, Hurricane Milton set to reach Florida as a Category 4 storm tomorrow. We will bring you the latest updates on its path and assess the potential economic damage as the region still recovers from Helene.
And we're going to take a look at Milton's impact specifically on the airline industry ahead of Delta's earnings results. What that first airline of the reporting season could signal about the health of the sector coming up here.
A tough start to the month for equities ahead of some key econ data out this week. According to our next guest, one survey could indicate where markets are heading into this year. And of course, at the start of earnings season, a couple of key things to keep in mind. Let's get into all that with Willem Sells. He's a Global Chief Investment Officer at HSBC Global Private Banking and Wealth. And Willem, it's great to see you again. We want to get into that bank lending survey. But first, I just want to get your thoughts on earnings, because one thing that stuck out to me in your notes as we get underway with earnings season here this week, you said you're focusing on areas of the market that can deliver earnings endurance. What does that look like? And what is the thing that investors should be watching for as they're trying to determine the companies that can deliver that earnings endurance?
Yeah, so what you're seeing in the equity market is more and more within all of the sectors, a lot of dispersion. So it becomes more difficult for a strategist to actually tell you where to put your money. And it's more an analyst, actually, the stock pickers, who are going to do that. That being said, the earnings season, has actually a relatively low bar in the third quarter. Remember, the second quarter, the bar was high and companies still beat it. In the third quarter, for some reason, the analysts have become more negative, even though the companies guided and the economic data, as you saw, for example, in the payroll data and the wages and the unemployment data, the economy is actually doing quite well. So I do think a lot of companies are going to, beat, those relatively conservative earnings expectations. And therefore, what we do is we broaden the sector exposure, but within each of the sectors, we let the analysts pick, those companies that are, the most resilient.
I'm curious, Willem, you talk about how we are going to have this resilient earnings growth, but you also say there's going to be some pressure on PE ratios moving forward here. Where does that leave us heading into earnings?
So not necessarily a lot of pressure on PE ratios, but it's not from the PEs that or the multiples that the equity expansion will come. It will come, indeed from those earnings. I do think that the bond market has already priced in a lot of the cuts, actually potentially a little bit more than what we expect. We expect only 6 further rate cuts of 25 basis points. So that will not necessarily allow for further expansion of PEs, but it needs to be those earnings. The good news is that, you know, the market is now looking for a no landing or a soft landing scenario. Soft landing even better, you know, to some extent than the no landing, because indeed, if you were to have a no landing scenario, then you know, the market could start to price out, remove some of those rate cuts, and that could lead to some of you know, some multiple contraction.
Well, when you take a look at the recession factor and how that plays into these calls, especially with earnings, when we're trying to figure out the stability of these earnings, the growth that we're going to see not only this quarter, but looking ahead into fourth quarter and 2025, what does that then tell us about what you think the odds are for recession and how important that is to this call in terms of the rotation and the outperformance that we could see in other sectors?
I see recession risk as relatively low. The Fed as well has confirmed, or in their opinion, that, you know, they don't see it as an imminent you know, threat. They you know, if the risks to the economy were to increase, that they are ready to cut more. So I think to some extent you have that Fed put. I don't think we actually to some extent need it, because the economic data are strong enough to avoid us sliding into that recession. So that's the economic momentum. I think from a fundamental and a more structural perspective as well, you have a lot of support for the US economy in particular, you know, which is everything around innovation and the infrastructure build out in particular, together with the supply chain reorientation and the re-onshoring. All of that puts a floor on their economic growth. So I would suggest that people don't worry too much around recession risk.
Well, Willem, ahead of that FOMC meeting, we are going to get the bank lending survey. And I'm interested in your call on this because you talk about what that could indicate. Typically, when companies are borrowing more, it could be an indication of some sickness under the hood. But you say it could be a positive sign.
Yes, it's a matter of optimism. You know, I do think that once you have, you know, the US election out of the way, so that uncertainty, you know, that CEOs can plan better. You know, at the same time, they have that economy which is going to do the soft landing or the no landing. And obviously, you have the rate cuts, which should make that financing cheaper. So easier to get a positive return on your investment that you are making. And so what the bank lending survey will tell us, you know, in its update before the FOMC meeting is number one, whether bank lending conditions are easing, getting you know, cheaper and more available to you know, to companies, but also interestingly whether corporates are willing to borrow, want to borrow, and that's very interesting, of course. And they break it down between large cap and small cap, so that will tell us as well, you know, whether we need to continue, you know, to go to follow that rotation in the market that the market tried to do versus small cap at one point in time. It will also tell us something around financials profitability. And also, you know, to me, the amount of investment that you're likely to see in areas like innovation and in technology and so on. So the bank lending survey is always an important one to watch. It's not just, you know, CPI and the Fed that we should be focusing on. Things like this are very interesting statistics to look at as well.
All right, Willem, appreciate you adding to the data pool for us with something a little new there. Thank you so much. Willem Sells, HSBC's Global Private Banking and Wealth Global CIO. We'll have all your markets action ahead right here on Yahoo Finance, so stay tuned for more. You're watching Catalysts.
Now time for some of today's trending tickers. You can scan the QR code below to track the best and the worst performing stocks of the session with Yahoo Finance's trending tickers page. First up, Weight Watchers announcing a new GLP-1 medication starting at $129. The company is looking to make the weight management solution, quote, accessible and affordable, offering an alternative to Wegovy and Ozempic. We know two drugs that we have talked about time and time again as this GLP-1 craze has really taken off. We've seen that reflected in the stock prices here of Novo Nordisk. We've seen it reflected in the stock prices of Eli Lilly. As a result, Weight Watchers has actually had taken a hit because of so much inroads here and the uptake here of GLP-1. So now the fact that they are entering this space, we're seeing that reaction play out here in the stock this morning. You've got shares up just about 8%. But if you take a look at that longer term chart over the last several months, or really since the start of the year, that will give us a better picture of the pressure that Weight Watchers WW International has been under. You can see year to date, it's lost about 90% of its value. And you can see, Maddie, that yes, this is a step in the right direction, but lots of questions just around what this new compounded GLP-1, what demand is going to look like. And whether or not people, yes, it is an attractive price, obviously, more affordable than some of the other options, but whether or not it's going to stack up and live up to the options that are out there from actual GLP-1 drugs here from Eli Lilly and from Novo Nordisk.
Yeah, and you can see the pressure that the stock has been over, even year to date. Oprah Winfrey, obviously one of the most famous board members at the company, leaving the board and selling her stake in Weight Watchers WW as well, following her decision to move towards a weight loss plan that incorporates weight loss drugs. And it seems that that is also part of the company's path forward here, and also perhaps part of the story behind the ousting of their most recent CEO, Seema Sistani. She was only CEO for about 2 years, and during that time, the company was transitioning to more of a weight loss drugs focused revenue model as opposed to their traditional revenue model of a more diet focused model. So it's going to be interesting to see what they think any other executive can do to kind of rebrand the company. It's kind of a hard sell to transition from those two formats of weight loss. So it'll be interesting to see what they think will move that forward here. But the share is certainly popping today, up as much as 30% in the pre-market today. All right, next up, Foxconn is announcing plans to build the world's largest NVIDIA super chip facility in Mexico as demand for AI surges. And taking a look on your screen here, you can see that Foxconn is down just about 1.5% here. But I want to talk about these super chips. This is a key component of the U.S. firm's next generation Blackwell family computing platform. So that is going to be a key growth area moving forward. And I also want to mention that Foxconn is the world's largest contract maker for something like Apple, right? The iPhone assembly is a big part of Foxconn's business. So that is why we take a look at a company like this. And it has certainly been benefiting from the AI boom as the expenditures on AI and specifically chips have continued to be a positive lift for the business. And being associated with a super chip facility from NVIDIA is certainly going to be a move to the upside for that as well.
Yeah, and some of the commentary that we got out from management here from Foxconn, just in terms of that demand and what they are seeing or what they anticipate to see for the Blackwell chips, I think is also adding to that upward momentum that we're seeing in NVIDIA today. With you got shares up just about 3%. Foxconn saying that the partnership between Foxconn and NVIDIA is very important. Everyone was asking about NVIDIA's Blackwell platform. He talked about the fact that their demand is awfully huge, to put it in their words there. And when you take into account maybe what ultimately this means for Foxconn, obviously a partnership here with NVIDIA, like you were just saying, Maddie, would be viewed very favorably here. And it's also important to point out that Foxconn said the plant was being built here in Mexico. Capacity there will be, quote unquote, very, very enormous. So that really speaks to just that ongoing demand, the surge in demand, healthy demand, insane demand, to put it in NVIDIA's words here, that they are expecting for their new Blackwell chip. And you can see shares of NVIDIA today moving to the upside, up just about 3%. Let's move on to General Motors. GM gearing up for its investor day today. It's its first investor day since 2022. Analysts looking to hear about the company's EV plans, the future of its cruise unit, and its China restructuring. An analyst from Wolf saying that low expectations could allow the company's message to be more constructive than anticipated. Meanwhile, Barclays' Dan Levy is saying that the theme for GM 3 years ago was, quote, growth motors, and now it's pragmatic motors. One focus will be the company's battery technology. GM CEO Mary Barra, she spoke to our very own Brian Sozzi about this earlier this year. Let's take a listen.
Well, we clearly have to demonstrate that the Ultium platform allows us to have a portfolio of profitable EVs that customers want to buy. Critical. That we have software in our vehicles that enables a better customer experience, an easier customer experience, and surprises and delights. And then that we craft the future path for Cruise. I mean, I really think it comes down to doing those three things well, while delivering the financial results and doing the right thing for our owners, our shareholders.
This very much is going to be front and center here at the Investor Day that kicks off later today. We will expect to see tours of Tennessee's plant battery, the EV assembly operations, as investors try to figure out just how GM is really shifting its strategy or adjusting its strategy, maybe in the wake of that lower than expected or weaker than expected demand here for EVs. Obviously a problem that's not only for GM, but what we're seeing play out across the wider auto sector here, Maddie. But I thought that Levy's comment there from Barclays talking about the fact that this year it's going to be all about being pragmatic here for Motors and capitalize the G and the M in that rather than the growth story. It's analysts very much want to get a better sense of what the company realistically is going to look like over the next several years, given the fact that there has been this recalculation and adjustment across the board as to the EV demand uptake and what maybe more realistically that's going to look like within the next 5 to 10 years.
And can they win by being flexible when it comes to the EV space and being nimble depending on what that demand picture does look like? Because we've certainly seen already that it can fluctuate. I think it's really telling that this Investor Day is going to take place at the vehicle assembly and Ultium EV battery plants in Tennessee. That is perhaps GM attempting to send a signal to shareholders, but not necessarily hitting Wall Street analysts' expectations here. We had UBS analysts saying that basically we remain favorable on the stock, but we don't see that much attractive risk reward going into this event. And also an analyst over at Wolf saying that expectations are relatively low as well. But we will continue to monitor any headlines coming out of this event for GM. Moving on here, residents along Florida's west coast are working around the clock to prepare for Hurricane Milton, the second massive system to hit the region in less than 2 weeks. We'll take a closer look at the economic impact of severe weather systems next, right here on Catalysts.
Almost an hour into the trading day. Let's take a look at how stocks are faring. We've seen a bit of a reversal here when you compare it to the gains that we saw almost across the board at the open. You've now got the Dow actually just below the flat line. Not a huge move to the downside, though, so definitely important to keep on your radar throughout today's trading day. On the flip side, we're seeing some outperformance from technology stocks. As a result, you've got the Nasdaq up nearly a 1% move to the upside. The S&P 500 also reversing the losses from yesterday, coming off its worst day in just about a month. And here we are looking at gains of about 0.5%. Russell 2000, you're seeing small caps catch a bit of a bid here this morning. It's up just about 0.1%. Checking in on the bond market, we've seen a lot of activity in crude. We've actually seen a bit of a reversal here today, and this has been the story throughout the morning. You're seeing a reversal of about 4%, moving lower on some of that news out of China. Again, though, putting it into context and taking a look at the run-up that we've seen really over the last 5 days. Let's start there. You can see we have seen this spike here, but taking a look at maybe a 10-day chart to get better in focus, over the last 10 trading days, you're looking at gains of just over 8%. We saw the massive run-up last week. It recorded a weekly gain of just about 9% on escalating tensions in the Middle East, and lots of questions about potential supply disruptions if we were to see a retaliation from Israel against Iran. Those fears very much still in play here, but we are seeing a bit of a reversal here from the recent gains, with crude now just below $74 a barrel. Flipping over to Bitcoin, we are seeing a bit of a movement there. That's coming off the highs that we have seen, and now off just around 2.6%. I've also got a 10-day chart up here, so we could talk about that move over the last 10 days. It's off just about 4.5%. If we flip over and take a look at the action that's playing out right now within the bond market, we've got the 10-year Treasury note here. Prices moving to the downside. We've got to move higher here in yield. So that, of course, is going to be a move to watch here. And taking a look at yield specifically, up just about 2 basis points above that 4% level, hitting the highest level that we've seen in just over 2 months. So again, lots of questions. And we've asked this to strategists, at what point does this level get a little bit problematic or worrisome here for the equity market? That doesn't seem to be the case yet. But again, as we do press higher, that is something to watch here in the upcoming trading days. Maddie?
All right, Shauna, thank you so much for giving us that market check. Well, preparations are underway across much of Florida's west coast for Hurricane Milton, expected to make landfall on Wednesday. We heard from Florida Governor Ron DeSantis last night on the severity of the storm.
All folks on the west coast of the Florida Peninsula should be prepared for potential major impacts. So we just went through Helene. A lot of people on the Sun Coast saw some significant storm surge. This has the potential to be much more significant than that and life-threatening.
The Category 4 storm is projected to bring widespread flooding and historically high storm surges to a region that's still recovering from the impact of Hurricane Helene. To put this all into context, we are joined by Andrew Friedman. He is a senior climate reporter over at Axios. It's great to have you on here to discuss this with us, Andrew. So just start by giving me some context about the size and scope of this hurricane and how it compares with previous severe weather events, even like the one we just saw impacting Florida.
Yeah, it's an order of magnitude stronger. This would be, if it makes landfall as forecast at a Category 3, this would be the strongest landfall direct hit in Tampa Bay in more than 100 years. It's very rare to approach that coast from the west. It's an ideal situation for setting up a huge storm surge, unfortunately, because the winds are blowing directly against the coast. And it's a very dire situation. There really is no analog for folks on the West Coast. They did just experience a very big storm surge of about 7 to 8 feet with a Helene. However, what is forecast for Tampa, Sarasota, areas to the south is 10 to 15 feet with this storm. That is absolutely unprecedented. In terms of the storm's intensity, it peaked at Category 5 at such a high end that it was the 5th strongest hurricane ever observed in the Atlantic Ocean. So this was a very rare storm. It's going to power down some of its winds, but it's actually expanding in size over time which will allow it to move more water towards the coast.
Andrew, as we're trying to figure out the potential economic impact of the storm, obviously these are just early estimates. Very much we can see the degree of the strengthening of this hurricane change very abruptly and very quickly. But I'm curious, just from your estimations of what you have seen in the past, given the fact that this storm is expected to be so strong, given the fact that it's happening so closely after Helene, what does that do just to further complicate those recovery efforts? And then, of course, the expenses that could go into this?
So it complicates the preparation and complicates recovery in certain ways. FEMA says they are prepared. The state is a pro at dealing with this. If there's any state that knows how to deal with multiple hurricanes back to back, it's Florida. But that's not to say that they have the resources that they really need. FEMA is saying they need more money from Congress. I think if you look at tabletop exercises of a hurricane making a direct hit on Tampa at Cat 3 or stronger, we're talking hundreds of billions in damage. So what that region is hoping is even a 5-mile jog to the south from Tampa Bay will make a huge difference. However, that's still going to be extremely costly because you're dealing with really heavily populated areas then near Sarasota, even all the way down towards Fort Myers. Yeah. These are places where a lot of people go to retire, where a lot of people go to vacation. I'm one of them. So they're close to people's hearts. And I obviously there's residents there that have had to evacuate, maybe saw damage in Helene and want to get out of there for this. And they just have today to be the last day that they can prepare.
Andrew, really quickly here, a final question I want to ask you because I know that you're a climate reporter specifically. Can you talk to me about the extent to which your sources are talking to you about the role of global warming and climate change in extreme weather events like this and how that could impact the severity of these events moving forward?
So climate change is really behind some of the trends that we saw in rapid intensification. The storm was over record warm ocean water, made about 400 to 800 times more likely by human-caused climate change. Climate change did not create the storm. It did not cause this. It helps enable it to be more capable of delivering heavy rains, more capable of delivering a higher surge because of sea level rise, and stronger in terms of wind speeds than it might otherwise be. So it is a factor here. Scientists are readily saying that, and there'll be analyses afterwards. Right now, I think the focus is on preparation, but definitely the climate context is in the front of people's minds as they watch this thing spin towards the coast.
All right, Andrew Friedman, thanks so much for taking the time to join us here this morning. Axios, a senior climate reporter. Thanks, Andrew. Hurricane Milton is expected to make landfall on Wednesday near the Tampa Bay area. The Tampa metro area is home to more than 3 million residents, and the region has not had a direct hit from a major hurricane in more than a century. Joining us now for more on the storm's economic impact, we want to bring in Richard Murnane. He is the CEO of Kinetic Analysis Corporation, a company providing data and tools to help its clients anticipate and to respond to natural disasters. It's great to have you here, Richard. Let's talk about maybe what you are telling clients, because putting this in perspective, when we were just speaking to Andrew over from Axios just about the significance of this storm, the last major hurricane to directly hit the Tampa area was 1921. So what are you hearing from your clients? How are you advising them to prepare for a storm of this magnitude?
Well, first off, thanks for having me. As what we do is to provide our clients with the most current estimate of what the distribution of winds, maximum winds, and storm surge is going to be, and we calculate that using our ocean and atmospheric models, and drive those models using forecasts from the National Hurricane Center. So the next forecast, as people probably are aware, is going to come out at 11 o'clock Eastern time. And we will take that information and within an hour, update our estimates of what the wind fields are going to be, the storm surge, the rainfall, and the waves. And our clients are really interested in what's going on, obviously, because many of them are in the insurance industry. And the wide range of this storm, that it's going to grow in time, and a large area of high winds are going to have a significant impact.
Yeah, they certainly are going to have a significant impact. I wonder if you can put a number on that for me, Richard, obviously ahead of what you're expecting to publish tonight. Right now, what do you expect the dollar amount in terms of damage to be?
Well, we don't estimate the total amount, but we give estimates of what the damage is going to be based on the winds and storm surge. We don't capture the impacts of inland flooding. But as the previous speaker was commenting on, the magnitude of the impacts are very sensitive to where this storm is going to go. A direct hit on Tampa would cause, hundreds of billions of dollars of damage. And in fact, a direct hit on Tampa is like the World Bank study has shown that would be one of the 10 most damaging impacts of a tropical cyclone hitting land in the world. But if it goes farther south, then the worst impacts of the storm are going to move out of the Tampa Bay area and affect people farther south, but it'll have less of an economic impact. With the current forecast, we are estimating, but just from the winds and the storm surge, anywhere from $70 billion to maybe $100 billion.
Richard, I want to pull up a chart board that we have of insurance stocks right now, because we are seeing a bit of a hit across the board as many investors are trying to evaluate just ultimately if we do see a hit to this degree, and this is a 2-day chart, but if you're taking a look at what we're seeing here this morning and some of the pressure that we had seen on these names since Helene, I think it tells a bit of a story about the fact that people are very worried about the degree and the strength of these hurricanes and what exactly that is going to do for claims. What are you hearing right now from your insurers, your clients, just in terms of how they're preparing or maybe what they are expecting, how big of a hit we could see to their profits as a result?
So I don't have direct information on the business practices of our clients, but I do know, given the focus that they've had on this event, and they're contacting us and saying, when is the next update going to happen? They're tracking it very closely on what's going to happen, and what's particularly concerning to them is the area of properties that are exposed to hurricane force winds, because that's very broad based winds, and you're going to have hurricane force winds all the way across the Florida Peninsula onto the East Coast.
All right, Richard, we got to leave it there. Thank you so much for joining us. Really appreciate it. Richard Murnane, Kinetic Analysis Corporation's CEO.
Thank you.
Well, coming up, we'll get an analyst's reaction to how travel could be impacted by Hurricane Milton and how airline stocks could be impacted as well. Stick around for that next, right here on Catalysts. Two Florida airports have already announced closures as Hurricane Milton is expected to make landfall on Wednesday. Airlines still recovering from closures and delays associated with Hurricane Helene last week. Here to tell us which names could see the biggest impact, we have Savi Saith. She is a managing director over at Raymond James. Savi, it's great to have you on to discuss this. So we've talked a lot today about the impacts of the hurricanes on the individuals in Florida, the economy of Florida, but specifically looking at the airlines themselves. Talk to me about the degree of impact a weather event like this can have on airlines and which airline you think is the most vulnerable to an impact here.
Yeah, thanks for having me, Madison. And like how I would frame it is there are two impacts here. One is the immediate impact of the hurricane moving through Florida, and as the airports are closed, that's short-lived, and that will impact more than just the Tampa-St. Pete area or Southwest Florida. That will impact Orlando as well as the storm works its way through. Usually, investors and earnings get a small hit, but investors look beyond that because it's a very short-term impact. I think the secondary thing that we need to consider is what's the longer term, or at least lingering on for a month, 2 months, 3 months, is what happens to the beachfronts, what happens to the destinations that people would normally come visit in Tampa, St. Pete area and Southwest Florida, and we'll have to see. And from that perspective, Allegiant is by far kind of the most exposed to that area. As well as you have a little bit of exposure, much less exposure at kind of like the JetBlue and Frontiers of the world as well.
Savi, I'm curious, how are you evaluating, or how do you evaluate the risk here of hurricanes? You're heading into earnings season. There's lots of questions already about what demand looks like, whether or not we're going to see demand taper off, especially into that all-important holiday season. When there are events like this, especially what's happening in Florida with two hurricanes so close, the timelines are so close together. How do you factor that in to your modeling, and I guess the compound effect from the fact that there's two storms so close together? How much does that then complicate maybe that demand picture longer down the line?
Shauna, how I would look at it is, the one, I guess, silver lining is at least Helene came through at a kind of a low season in terms of leisure demand. So that's been a silver lining of it from a travel demand perspective. And the potential impact to the airline. So I think Helene itself, the immediate impact was not great. It does impact earnings a little bit. There's a little bit more risk with Milton because you're getting around that fall break time frame where there might be more demand here this week, next week. Again, I think for Allegiant, fourth quarter, we'd be a lot more cautious on what that means to earnings. We tried to kind of reflect Helene and maybe the aftermath there when we did our preview last week. Milton was still not in the picture. So from an investor perspective, I think that makes people cautious heading into earnings season. But from a longer term perspective, again, I think if you think about demand, some of that demand that would have gone to kind of Western Florida might get diverted elsewhere. So I think demand will hold up. It's just airlines that are kind of exposed to that region might be a slightly longer impact, but over the longer term, I think this is kind of overlooked by investors as a kind of a one-time hit.
And broadening out the conversation a little bit, Savi, I want to get your thoughts on Spirit Airlines. If we take a look at our board of airline stocks here, you can see that Spirit is the only major airline that is under pressure, at least on today's session here, still struggling to reach a rescue deal with creditors. I'm curious from your perspective, how much upside growth does the challenge of Spirit spell for some of the other airline names?
Yeah, I think what we've seen in the U.S. is there's too much capacity, especially a bit on the low end of the market. And the reason for this is just, since COVID, we've just had a lot of labor cost increases. It's wiped out about 6 points of margin from 2019 levels, just in terms of labor costs. Then you had to layer on some of the costs for maintenance parts and supplies. You layer on costs of air traffic control, working through less productivity there. There's a lot of pressure on the cost side for airlines. And so we just need to get higher pricing than we would have seen in 2019. So demand is good and strong, but we really need higher pricing. So there's just too much capacity for the level of pricing that this industry needs. And you've seen Spirit go a long way this quarter. You know, their capacity is going to be down 20% year over year in the fourth quarter. So I think Spirit is doing some of the hard work of eliminating some of those most kind of least profitable markets. The question now for Spirit is, can they adjust their fixed cost structure to be a much smaller airline? And there are going to be some kind of difficult conversations around that, I think, that Spirit needs to have. And the question is, can they do it inside or outside of bankruptcy? For the other airlines as a whole, I think, again, it's not just Spirit that's adjusting capacity. They're doing a lot of the heavy lifting, but you're seeing all these other airlines slowing growth or cutting growth, except for maybe Delta and United. And so I think that's going to go a long way to improving the supply-demand balance in the industry to get those higher fares that the industry needs to kind of recover margins here.
And Savi, real quick, we only have about 30 seconds here, but what's your top play heading into earnings season? We've got Delta later this week. We've got United next week, followed by American Airlines. Where do you see that most opportunity?
Yeah, I mean, I think if you think about the very short term, there are probably, you know, we called out in the very short term, the one's best position might be like Alaska, Frontier, and JetBlue here, just given the dynamics of where the demand and pricing recovery is showing up.
All right, Savi Saith, always great to have you here, Yahoo Finance. Thanks so much for joining us here this morning. Raymond James, Managing Director. Thanks, Savi. Coming up, Google could soon learn how the Department of Justice wants to break up the tech giant's search engine empire. We've got that for you next. Short seller Hindenburg Research has a new target. The company announcing a short position in the popular children's video game maker Roblox, alleging it's inflating its metrics. Joining us now for more, we want to bring in Michael Pachter. He is Wedbush Managing Director for Equity Research. Michael, you have an outperform rating on the stock, a $49 price target. Let's talk about this report that we just got out from Hindenburg earlier here this morning. We're seeing the reaction play out in the market. It looks like the street's a little bit concerned about some of the things that were brought up, issues that were brought up here, questions about the metrics within this report. What's your response?
You know, I don't question that anything in this report is wrong. I'm sure that they have a factual basis for everything they alleged. I'm not sure that it matters. And in particular, you know, there's really only two things that they spend a lot of time on: the number of users and the child predators on the platform. So, you know, talk about the number of users. They say that Roblox has inflated that number. And I can't question that. I don't know. And the reason they think it's inflated is that they say that each user has the potential to open up many alternate accounts, and people do. I don't think the vast majority do, but some do. So they're measuring users, and that might be, they might say 79.5 million daily active users when the number, according to Hindenburg, is 22% lower than that. So let's just say 60 million. Who cares? The revenues went up from 2.8 billion to 3.5 billion from 22 to 23, and they're going up again to 4.2 billion this year. So do I really care as an investor if the user count has been consistently inflated? I don't. So again, I think that's about 2/3 of the report. The other third was about child predators, and it's a serious problem. And Hindenburg accurately pointed out that Roblox spent $878 million last year on safety and security on $3.5 billion of revenue. So 25% of revenue on safety and security. What they neglected to mention was what Bloomberg reported on this past summer, which is that there were 13,000 reported incidents, self-reported by Roblox, to the National Center for Missing and Exploited Children. And that number was up from 3,000 the year prior. So they're catching more predators. Is that a problem? Well, yeah, the number 13,000 is scary, right? But when you think about it in the context of 80 million people visit per day and over 300 million active users, monthly active users on the platform, we're talking about 45 incidents per day out of 80 million visits. I don't think that anyone can expect these guys to come up with zero tolerance. They're spending $878 million to catch the 40 a day that they're catching. That's a lot. And honestly, I think this is like reporting on the border and looking at apprehensions and saying that's a problem at the border. It's good when you catch more people. You catch more people breaking the rules, you're going to eventually wipe them out. So I really think this report is built on, a shaky foundation.
So Michael, just to follow on the instances of unsafe conditions for children on the platform, you mentioned the Bloomberg reporting. In that report, they also talk about individual users, parents of children who were consistently reaching out to Roblox, and it was falling on deaf ears. If that behavior continues, not only is it, of course, a moral problem, but also it's a legal problem potentially for the company. Is that a headwind that you're perhaps underpricing?
If the number was 1 million or 2 million or 5 million.
It could be. We don't know.
We don't know. What we do know is that the number of predators captured, apprehended, and reported went up dramatically, and it's still a small fraction of a percent of engagement. It's nothing. And, I think that the truth is, no, we haven't had anybody, anecdotally, sure. Can you find a parent? Yes, you can. But can you find 1 million? I mean, we would know. If there was that many people would be boycotting Roblox, and it's just not happening. Each of these two reports, Bloomberg and Hindenburg, cites about a dozen, examples of predators, maybe 25 or 30 in the Hindenburg report. Out of 300 million, I mean, of course you're going to find that. What I think is interesting, though, is Bloomberg pointed out accurately that most of the predatory activity is shifted over to Discord. That the predators, groom the kid, recruit the kid, and then get him to go over to Discord so they can molest them, over internet molest them, share pictures or whatever, because Discord isn't policed as well as Roblox. And Bloomberg acknowledged that Discord's a bigger cesspool. So I think the fact that you can't get it done on Roblox speaks volumes about the efficacy of their safety and security.
Michael, I guess my real quick question for you as we wrap this up is about partnerships and how that plays into safety. When you take into account that they do have partnerships with well-known brands, including Nike, Walmart, L'Oreal, does that put that in jeopardy? Does that matter? Or is that just a small piece of the pie?
It matters a lot over the long run, but I don't think that anyone can make the argument that Roblox is less safe than the cesspool formerly known as Twitter. And they get advertisers, or the cesspool that is formerly known as Facebook, Meta. Those guys have bad activity, Nazis out there, people actually conducting terrorism on their sites. So no, I think that, a brand is going to be concerned, and I think Roblox can show them the data and I think put the brand at ease. You're going to have bad people anywhere you go. spending a quarter of revenue to try to root those people out speaks volumes to the integrity of management and to the efforts they're putting in.
All right, Michael, thanks so much for joining us on this semi-breaking news today. I really appreciate it. Michael Pachter over at Wedbush. Well, fresh legal trouble for TikTok here. More than a dozen states suing the social media company, alleging it has a negative impact on the mental health of teens. Yahoo Finance's senior legal reporter Alexis Keenan joining us on set with more. Hey, Alexis.
Yeah, so this one just coming down the pike. There are 14 state attorneys general who are bipartisan as a group, but filing their respective lawsuits against TikTok in separate states, in separate courts. So a lot of activity here. I'm just learning what some of these complaints say. In the case of New York, the complaint says, and these complaints are pretty consistent throughout the states, says that TikTok is violating consumer privacy laws and harming children. How? They say using addictive features like autoplay, scrolling to keep kids engaged on the platform. Things like beauty filters and likes are damaging their self-esteem, they say. We've heard a lot of this in the past when it comes to Facebook, Meta, and trying to keep kids on the platform and engaged. So that's what this case is about, or these cases are about. The asks here are for TikTok to stop using these tactics, to impose financial penalties, as well as disgorge them of the alleged ill-gotten gains from these practices. Also looking for some damages here for the users that they say who have been harmed.
Alexis, I want to switch gears very quickly and go to another story that you've been closely tracking, and that is Google. This week, we could hear updates here from Google's antitrust case, the fact that it could reach its next phase, potential remedies. What are we listening for there?
Yeah, so what we're watching for today is a filing that is due today, and it is supposed to come from the Justice Department, and it is supposed to lay out the potential remedies, things that the Justice Department thinks should be imposed on Google for losing that case back in August in search, where it was found to have been conducting an illegal monopoly. Now, search advertising as a whole accounts for $238 billion of Google's revenue. So that's a huge bucket that we always point to when we talk about this case. Search is a big one for Google to have to be disrupted in. We don't know what these remedies will be, but here's what the DOJ is expected to ask for. Again, we haven't seen this complaint, this filing, so we don't know. But things like ending the default contracts that puts Google search in a default position when it comes to browsers, and also devices that are programmed with Android operating system. Also divesting potentially Android and Chrome so that Google has less control over setting those defaults. Also sharing click and query data. That's when you put in a search into Google and then its algorithm does its magic in order to give you the best results that it can. Also giving consumers a choice of browser when they open up a device that's connected to the internet. So that's what we're expecting we might see here, but there's a lot more to come potentially. We don't know what the DOJ is going to say.
All right, Alexis, we look forward to your reporting on that. Alexis Keenan, thank you.
Well, coming up, we've got Wealth. It's dedicated to all of your personal finance needs. Our very own Brad Smith is going to have you right here for the next hour, so stay tuned for more.
Welcome to Wealth, everyone. I'm Brad Smith, and this is Yahoo Finance's guide to building your financial footprint. Our community of experts will give you the resources, the tools, the tips, and the tricks that you need to grow your money. Hey, on today's show, all eyes are on Thursday's big inflation report. We'll track which items are seeing the biggest price increases and some decreases. Plus, the Social Security Administration will announce the cost of living adjustments for 2025 pegged to that CPI report. Stay tuned, we'll tell you more this hour. And the state of small business owners. Will dig into how Main Street is feeling about the economy, and we'll also zero in on women-led businesses and the hurdles to starting a business. And plus, consumers are feeling better about the housing market, with many expecting mortgage rates to fall in the next year. But rates are currently rising. We'll talk all about it with Yahoo Finance's housing reporters. All that and much more coming up during this hour. But first, let's take a look at some of the market action. We're 90 minutes into the trading day. We've struck the top of the 11 a.m. Eastern Time hour, and we're taking a look at a mixed picture in the stock market this morning as investors look for any clarity on the Fed's policy pathway forward, with more insight coming in the FOMC minutes. Those are due out Wednesday. So, how should you prepare your portfolio for a market that isn't exactly sure where rates are heading in totality? Here to help weigh in, we've got Adam Coons, Winthrop Capital Management Chief Investment Officer. Adam, great to have you here. To the extent that your crystal ball is working right now, mine's in the shop. What are you expecting at that next FOMC meeting? Is it a continuation of 50 basis points, or is it 25 basis points, as the most recent jobs report would certainly put some cold water on that 50 basis point expectation?
Yeah, certainly the data is making it difficult to know what the next move is going to be. Because while the jobs number was better than expected, on the flip side, we also know that revisions lately have been significantly to the downside. And my guess is that's probably what we'll see a continuation of. So the Fed's in a tough place, and I think they're still going to try to kind of feather this softly. I think the 50 basis points out of the gate was a good move to just kind of start this, I guess, end of the tightening cycle. I'm not going to say that this is necessarily loosening. So I think that what they're going to do is play it safe and go with a smaller cut. I think in our opinion, we're probably going to get a 25 basis point cut, and that will be it for the rest of 2025. Now, like you said, my crystal ball is a little bit fuzzy as well. So when we're trying to make that prediction and we're positioning portfolios, we're doing it with a more defensive tilt. Obviously, there's a lot of things, a lot of ingredients in the soup right now. When you look at it, we've got Fed policy, we've got an election, and then there's a lot of global issues going on that, could be black swan events. And so I think taking a more defensive tilt heading into year end is a good bet. You obviously have had a great run in equities, S&P 500 up, 20% or so. So you've had a great year. Now's the time to take a few chips off the table. I'm not saying move away from equities, but just go into a lower volatility, a higher quality, like I said, a more defensive kind of positioning within your portfolio right now.
What do you anticipate the most significant of the black swan events is?
That's difficult. I mean, look, if the Fed disappoints markets and doesn't cut at all, or even the 25 basis point could be considered a little bit disappointing. Part of it is what the reason for that, lighter move would be. That could be a big impact on markets. But obviously, the geopolitical issues, I think, are the biggest black swan potential. Is really the biggest one is what's going on in the Middle East. And so I think if we saw further escalation there that could draw in other countries, that's where that kind of thing that's really difficult to position a portfolio for that kind of black swan. But that's what I would say is probably the biggest thing that could happen heading into year end.
And if that were to play out, does that just mean a double down on defensive, as you were mentioning a moment ago?
Yeah, I mean, and then further that, I think you would really want to look at your fixed income portion of your portfolio, because if you're really trying to protect against those type of events, you want to be in a higher quality, maybe a higher allocation to your fixed income. That is one thing we're doing, and we're actually looking at longer duration longer maturity type fixed income to lock in rates, because if we did see that usually leads to what's called a flight to quality. And so you would see a lot of buyers, especially globally, of U.S. Treasuries if we did see an escalation like that. So we actually are positioning portfolios to increase our allocation to 10 and 30-year U.S. Treasuries through something like an ETF like TLT would be a good example of a way to position that way.
Just lastly, while we have you here, Q3 earnings season, what do you anticipate the broader theme that could prevail might be?
It's all about, the look forward. I think the actual earnings this quarter are going to be a kind of a non-event. The revisions to earnings have been to the downside since midsummer. So I think the bar is pretty low. Like I said, I think it's less about what happens with the release of these earnings and more about what companies are saying about what they see in the fourth quarter, what the consumer looks to be doing, their habits, their behaviors, and whether the inventories are going to be in excess, meaning that they're going to have to lower prices. So it's really going to be all about that look forward to the fourth quarter and the kind of holiday shopping season and what corporate America sees kind of around the corner.
Adam Coons, Winthrop Capital Management Chief Investment Officer. Adam, great to see you. Thanks so much for taking the time here with us today. Well, turning now to Thursday's all-important inflation report, the latest CPI data set to give a read on how prices are changing for many household items that you use every single day. Here to break down where prices are ahead of that report, we've got Morning Brief and Catalyst's co-anchor, Shauna Smith. Hey, Shauna.
Hey there, Brad. All right, let's talk about the report that's coming out later this week, because inflationary pressures, they are expected to ease. Expectations are for prices to grow by 0.1% in the month of September. Now, that would be a slight slowdown from the prior month's data. And that's the case for the annual growth, too. But if you exclude volatile food and energy prices, we know that is the core reading, what investors, what economists really focus on. Well, economists expect price growth to remain unchanged at 3.2%. We've seen a number of categories where prices are quote unquote sticky. We've heard that from so many of our guests here over the last several quarters. Take a look at housing. Shelter prices rose 0.5%, about 0.5% last month, or in the last reading, which was the August reading, and they were the driving factor for all of price growth there for that month. Prices for food have also remained stubbornly high. Food at home, think your grocery prices, they were up 0.9% in the month of August from a year earlier. And price growth for food away from home, that's when you're eating out at restaurants, if you're going to fast food chains, that was actually up 4% on a year-over-year basis. We also saw price growth in airfares and education and insurance, apparel in the last reading. Zeroing in on some of those worst offenders here, you've probably noticed it when you've gone to the grocery store. Well, in the grocery aisle, egg prices, we've seen a bit of relief when you compare it to the staggering numbers that we were seeing not too long ago, but they're still up 28% compared to where they were a year ago. Frozen juices and drinks are up 18%. Hot dogs are up 11%. And looking at the auto space, the cost of auto insurance, that's up 16.5% from a year ago. And if you're out and about, you better get ready to pay up. Tickets for sporting events, they're up 7.2% from a year ago. And tickets to movies, to the theater, to concerts, that still cost you 3.5% more than you were paying a year ago. There's a common theme here. So we're keeping an eye on some of those categories as we head into the September inflation print. Certainly, I think so many of our viewers are feeling this on an everyday, a daily basis here when they head to the stores, when they go out for any sort of events, if they're going out to eat, especially at those restaurants, with a 4% increase compared to a year ago. And I think as a result, and PepsiCo's earnings really put this in perspective, I think for so many of our viewers and for Wall Street here this morning, consumers are faced with a very, very tough choice, and they're being forced to pull back on some of their spending. And that is being reflected even in some of these consumer staple stocks, which are often viewed as more of a defensive play, especially in this type of economic cycle.
So that's where prices stand for many items. What is the biggest thing investors are watching for in this report?
I think in this report, it's going to be many of those sticky prices. I think going forward, when you take into account the massive run-up that we saw in oil prices over the last, week and a half at this point, 2 weeks, that is something that is of more concern. I'm seeing that creep into more analyst reports, more economist reports here over the last 7 days, not necessarily going to be reflected in this report that we're getting later this week, but going ahead when we talk about so much of the progress that the Fed has made on inflation, the fact that they are very confident that inflation will eventually get back to that 2% target. They are confident confident in the fact that it does continue to cool. Any sort of blip there or any sort of, I guess, refocus from the Fed away from jobs, which they very much have been over the last couple of months, and any sort of refocus back on inflation driven by the uptick that we're seeing in oil prices, that would be a real concern here for investors.
Yeah, looking at a data point here from Santander, more consumers, 81% according to one of their surveys, consider inflation a major concern in Q3, 86% saying it's impacted their daily lives, which just goes hand in hand with this conversation here.
It does.
Shauna, appreciate it.
Thanks, Brad.
All right, we're all going to be breaking down that number later on this week. But until then, median job switchers see a 10% increase in pay, but their retirement savings rate often drop nearly 1%, according to a Vanguard report. To discuss how you can keep the momentum going in your retirement savings account while switching jobs, we've got Kelly Han, who is the Vanguard Investment Strategy Group Head of Retirement Research. Kelly, great to have you here on the program with us. So make sense of this for us. It seems like the friction point in continuing this momentum is when you are switching jobs. Why is that?
Well, thank you so much for having me join you today, Brad. It's really great to be on this newscast. Well, changing jobs is really common. So when you think about the millions and millions of people who are changing their jobs on an annual basis, we see that they're experiencing a lot of friction points. And one of those friction points, as you're pointing out, is the slowdown in retirement savings rate. Well, why is that happening? Well, we find that typically a worker who's changing their jobs, their income goes up, but their savings rate, as you said, it goes down by 1 percentage points. And many of those are related to the employer sponsor design. Oftentimes people forget to sign up for their employer sponsor retirement savings like 401k, or oftentimes employers are defaulting people at a rate that is a lot lower than what they were saving previously. So people are losing the savings momentum as they go through the job transition cycle.
And so what is the way to make sure that this doesn't happen to you when you are switching jobs? What is the step that you need to take as you're getting into that new position and understanding that you've started contributing to a retirement account with one employer and need to make sure that you're also taking those savings over into your new plan as well?
Sure, that's a really good question. I think the first thing that we need to do is take greater ownership or more control about what our retirement planning really looks like. So what that means is understand what your current employer is offering in terms of the retirement benefits and know what you were doing before to have the same trajectory in terms of meeting the retirement goals. So I would say having a retirement plan is obviously the number one foremost important thing, but how the changes that are impacted through the job changes will have implications on the retirement trajectory that you're going to be on. So make sure you know what your current plan is offering and that you port over the retirement savings rate from the prior employer to have the momentum.
We know that this Thursday, the cost of living adjustment, also known as COLA, is out. And for those who don't know, COLA, it's an increase made to Social Security benefits to counteract the impact of inflation and rising prices, according to Investopedia there. And so as you're kind of thinking through this, what should folks who receive Social Security expect from an announcement like this that comes off the back of the Consumer Price Index?
Well, the good news is that inflation has gone down, right, over the years. So on the flip side, the cost of living adjustment that we're expected to see from Social Security, it's going to be less. But what I want to encourage your viewers to think about is what we can control. And what we can control is the Social Security claiming age. Claiming as late as we can at age 70, that locks in the growth of the benefit that we will receive in perpetuity by 8 percentage points on an annual basis. So what I would encourage the viewers to really focus on is what we can control versus what we cannot control, which are related to COLA and the trust fund deficit, et cetera.
Kelly Han, Vanguard Investment Strategy Group Head of Retirement Research. Thank you so much for taking the time today.
Thank you so much.
Absolutely. Everyone, coming up, we're checking in on Main Street with the latest NFIB Small Business Survey. That is next on Wealth. Main Street is feeling uncertain. The National Federation of Independent Businesses Uncertainty Index jumped in September to the highest level on record as small business owners, they weigh inflation pressures and the November election. Joining me now, we've got Holly Wade, who's the Executive Director of the NFIB Research Center. Holly, great to have you here with us. Help us break down some of the uncertainty that small businesses are facing right now and how this compares to last month's reading as we were discussing.
Sure. So uncertainty, as you mentioned, hit an all-time high for our 50-year survey. And a lot of that has to do with the uncertainty around the election, what that means for small business moving forward, what type of environment they'll be operating in. And they're facing a big tax hike, possibly at the end of 2025. So all of that is weighing on small businesses. That's why we saw that huge jump in uncertainty last month. But in addition to that is what the Fed is doing. So looking ahead, seeing how that might impact their decisions on financing, capital expenditures, expanding their business. Financing, not surprisingly, has been very expensive for many small business owners. And so that's been weighing on them as far as making decisions about their business and what type of options are available to them in whether it's investing profits into their business, which is their main source of financing, or paying those high interest rates in financing, again, equipment purchases, land purchases, expanding their business. And so kind of thinking through what that might mean for them, what Fed policy going forward means for them in maybe more affordable financing options. But that's putting a lot of uncertainty and a lot of question marks for small business owners in how to operate their business and make the best decisions based on, what they're looking to do.
I was looking at some survey data from GoDaddy, and it was interesting because they were talking about very similar metrics that you're tracking small businesses up against right now, and noting the amount of small businesses that account for so much hiring. I think it's about 2 out of every 3 jobs that small businesses are relied on for new jobs added into the economy. With that in mind, how is this flowing into the broader labor market, the hesitancy or at least the uncertainty right now for small businesses, and how that could have a broader impact on the employment situation?
Sure. So uncertainty, it permeates through pretty much every aspect of business operations, including employment. However, employment on our questions related to unfilled job openings, hiring plans, those have held up pretty well over the last year. We've seen a decline in those saying that they have a job opening that they currently aren't able to fill, but we're still in very high levels, back to where we were in 2019, similar with hiring plans. So we've fallen off from kind of the stratosphere levels that we've seen over the last number of years, but the labor market, as far as what small business owners are reporting in our survey, still look fairly strong. But again, those uncertainties are going to impact how they move forward, whether they are going to fill those open positions, whether those hiring plans, whether they'll follow through with that. But in addition to that, we are seeing compensation plans and also what they've done in the past quarter, still strong numbers. So those compensation pressures, while they've eased off a bit, are still an issue for small business owners in retaining current employees, the retention element, recruiting applicants for those open positions, especially in some sectors, certain sectors, including construction, manufacturing, transportation. Those business owners in those industries are having a particularly difficult time.
As we think about where small businesses are placing their priority, kind of looking at and amid the fourth quarter of this year and hoping to close the books on a positive note, and then looking out and planning for 2025, what are you hearing some of the top priorities for small businesses in 2025 are?
Well, right now, there's a lot of concern about what their tax rates will be. That 20% small business deduction on qualifying income was a huge benefit for them in the 2017 Tax Cut and Jobs Act, and that is expected or is set to expire at the end of next year. And so that's one of the main concerns that they have moving into 2025 is that Congress pass legislation to make that permanent, that the administration follows through and signs. And they're looking for a lot of uncertainty on that front. And then also inflation. We're still seeing almost a quarter of our members saying inflation is their single biggest problem in operating their business. And so a lot of business owners are looking for some relief on that end or continued relief. We've seen, the inflation rate decline ease up quite a bit, but, a lot of small business owners are still struggling trying to absorb those cost increases in their business.
Holly Wade, NFIB Research Center Executive Director. Holly, great to speak with you, and thanks so much for breaking down some of the findings within the most recent data from NFIB with us this morning.
Thank you.
Absolutely. Keeping with the small business theme, H&R Block unveiling its 2024 State of Women Small Business Report, which uncovers findings from over 6,000 applicants of its Fund Her Future Small Business Grant program. And there are plenty of good takeaways in this report. Here to discuss, we've got Jamil Khan, who is the H&R Block Chief Strategy and Small Business Officer. Jamil, I want to get right into it here. Tell us a bit about the women surveyed who are applying for this grant.
Yeah, happy to share more, Brad. So we ran this survey of 6,000. They're women-owned small businesses. They've applied for our grant program. We provided $100,000 of grants to these women-owned small businesses and gave them the opportunity to answer this survey, and with some great insights to share from that.
And so overall, how are these business owners feeling about their businesses in relation to the current economic backdrop?
Yeah, so it's a really good question. So interestingly, there's a really high level of optimism and confidence about the next year. When they think about the business, their financial position over the next year, they feel really good. Having said that, there's a little bit of a contrast. There's also some concerns around inflation. And over the next year, as you can see in the data here, 44% feel they may be forced to cut expenses and also will need to raise prices again. But despite that, there still is a lot of optimism about the next year and the future state of their business.
And so we also know that the survey found significant funding and support gaps for women to start businesses. Yeah. So tell us about that and why these barriers are still existing right now. I mean, it should be much more, it's opportunistic to start the business, but there are still some of these barriers that we need to break down.
Yeah, it's a huge level of frustration. It's partly why we offered these grants to try and kind of level the playing field. But what we found of women who have applied for a bank loan, 42% of them have been denied, which is a staggeringly high number and much higher than you see for male-owned businesses. And it gets even worse with women of color. We saw nearly 50% of Black respondents were never approved versus 36% for white counterparts. And what's really interesting is due to this lack of funding, we've seen that 90% of all of these small, these women-owned small businesses are using personal financing to get started. They're using credit cards, they're using their savings, so they're really putting everything they have into their business to get it off the ground.
How does that impact more long-term the ability for the business and the continuity plan as well?
Yeah, I think it's a concern. What it's doing is putting some people off from actually starting their new business. But there's like I said, a huge amount of optimism. So people are investing, they're starting small, and then they're trying to bring in their revenue, which is why, as I mentioned earlier, you'll see some prices might be increasing.
While we have you here and we're talking about small business, there is, of course, a critical weekend day and Small Business Saturday that's going to obviously take place right after Black Friday. How critical is Small Business Saturday? I mean, I remember to always mark my calendar and go out and try to, if I have, some money that I've been able to set aside for holiday shopping, make sure that some of it's allocated for small business spending. So how critical are days like that for small businesses?
Yeah, it's really important, and I'll share a couple of things. We know about 70 cents of every dollar that's spent on Small Business Saturday stays in a local community. But what's really interesting from our survey of the women-owned small businesses is that 98% of them have started their business to help their local community. So they're not only doing it, as an income for themselves, but they want to help the local community. So something like Small Business Saturday really helps with that. And a lot of that money, the majority of the money staying in the community really helps. So it really fits in. And I think it resonates a lot, particularly with these women-owned small businesses.
Yeah, it's a really great point of the circulation of that money supply within the local municipalities and local constructs as well. Jamil, thanks so much for taking the time here on the day. Jamil Khan, H&R Block Chief Strategy and Small Business Officer. Great to see you.
Thank you very much. Thank you.
Coming up, everyone, we're going to continue our discussion about women in business. Our next guest coming to the table with actionable financial tips for women. Stay tuned. A transfer of wealth is coming. In fact, a great transfer of wealth, the great wealth transfer as it's been dubbed, set to put women in control of the majority of finances by 2030. That's according to Women's Wealth Research. So, helping women gain financial confidence is even more important than ever. Here with me now, we've got Candy Valentino, business and wealth growth expert and author of the book you see right there on the screen, The 9% Edge. Candy, great to have you here in studio with us.
Thanks for having me.
We're going to get to some of the themes in the book here, but first and foremost, when we talk about the great wealth transfer, how do you see this impacting and closing hopefully the gender wealth gap as well?
It's such an incredible time for women in wealth. So, we know right now that about 35 to 45% of the U.S. wealth is controlled by women, and we're going to go that over 2/3 by 2030. So it's a really great opportunity for women to start understanding money. And it's not something that we're taught in school, and it's something that's typically scary for women to fully understand, but it's only because it's new. So it's really a great opportunity for women to really understand that, hey, this is a concept I can learn about, I need to understand it, I need to educate myself so that I can start making my money work for me.
And so with that in mind, where are some of the biggest shifts in financial management that you expect to come about as we do see education, but then actionability on the other side of that?
Absolutely. And I think that you actually alluded to on your prior segment when you were talking about women in small businesses, right? So we come from, my generation. When I first got my first small business loan in 1999, women weren't even allowed to, for just 10, 15 years, get a small business loan without a man's signature on the form. Wow. So we've come a long way. And so this is a great opportunity. Now we see more women in business. We see more women wanting to get investing. And so it's really about starting. Oftentimes we think we need to understand it, but I always use the analogy that if Tom Brady waited to be a Super Bowl champion, he would have never got on the field.
Right,
you
just
have to
wait
throw.
your turn.
That's right.
Yeah.
You have to throw the passes
right.
in order to be the champion. So investing is all about behavior. We always say it's only 25% knowledge, it's 75% behavior. So what you do with a little tiny bit of money, start investing now, will determine what you do when you start to earn more money.
Yeah, absolutely. And so as we think about one of the themes that you talk about, this 10-10-10 strategy, what is this, and break this down for us?
I like to keep it super simple, because if it's super simple, we can understand it and we can duplicate it. So how do we increase our earnings by just 10%? If we just ask better questions, we can get better results. How can we increase our earnings? Can we look at promotions? Can we start something on the side, a small business that we can start to make more money? How do we go through and start to reduce our expenses by 10% so that we can bridge a gap and start investing 10% of our money? Because again, even if you can't do 10% now, start with 5 so that eventually you can ramp up to start saving and investing 20% of your total taxable income.
It's a great kind of easy to remember strategy as well here. When we were talking about this in our previous segment as well, about how many businesses, small businesses that are run by women, contribute actually back into the local community as well. I mean, one of the things that you talk about is considering community. How do we kind of marry those two things together and making sure that in starting your small business or in having an investment strategy that you are considering community as well?
So it's very interesting. We found that when women control more wealth, that they're also more philanthropic. So not only do they like to learn in community, but they're also involved in their community. We look at some of the richest women in the world, like Scott and Gates, and how they're just giving a lot of their funds away. So we know that when women make more money and they understand money, that they actually do good things with it. So not only educating yourself, but getting around other people that are also starting to have this. Because if you and I are best friends and we're wanting to plan a weekend trip and you want to go super bougie and I'm trying to live on a budget, you're probably going to pull me out of my budget, right? So we need to have community of like-minded people.
Look, I'm usually the one that's saying, hey, let's pull this back a little bit here. But I appreciate you thinking that I'm going super bougie on anything. Just lastly, while we have you here, when we think about the great wealth transfer and the biggest shift that we could see in even the types of investments that are being made, what are you kind of tracking up against, especially right now, knowing some of the historical plays that have been made in the investment thesis and how that could shift once we see this great wealth transfer come to fruition?
So I'm going to break it down really simple. So number one, if someone watching right now has a job that they have a 401k or something that their business is giving them money for, don't ever trip over $100 bills that are laying on the ground. Pick those up, take that, make sure that you go all in on whatever retirement vehicle. Second is if you already have done that and you make less than $146,000 a year, you're eligible for a Roth IRA. It's a great place to start. You can actually invest up to $7,000 a year so that you can set it and forget it and start to invest that money all the time. The third thing would be if you're like, okay, Candy, check, I got that. Well, now we need to look at building a diverse portfolio and all that means is to have a bunch of investments that aren't necessarily tied together. So you might want some tech investments, you might want to do some ETFs, you might want to do a REIT or start to dabble in real estate investing. So those are kind of the three big buckets that you want to check off so that you can start to take that 10% that you bridge the gap by the 10-10-10 and really start investing into the future.
Great advice, great tips. Candy Valentino, who is the business and wealth growth expert and author of The 9% Edge. Great to have you here in studio.
Thanks for having me.
Absolutely. Switching gears, everyone, lower mortgage rates, boosting confidence in the housing market, but some cities might feel the benefits more than others. We'll tell you where, next on Wealth. You're watching Yahoo Finance. A positive sign for the housing market. Consumers are becoming more confident. Many expecting mortgage rates to fall in the next 12 months. Joining me now with a closer look at the data. Oh yeah, we got some full newsroom coverage on this one. Yahoo Finance's Claire Boston and Danny Romero. Claire, let's start with you. You're looking at the Home Purchase Sentiment Index. What are we seeing in that data?
Yes, so this is a Fannie Mae survey of a few data points, including expectations about mortgage rates, whether or not it's a good time to buy or sell a home. And what we are seeing is consumers feel pretty confident. This is the highest reading for this index in about 2 years.
Interesting. Okay, so Danny, you're also kind of taking a look at the impact of falling mortgage rates. Some markets more affected than others is what we've heard, though.
So housing activity is about to spark up. So with lower rates, Realtor.com found that certain markets will actually see more appetite for housing. Some of those markets include, for example, Washington, D.C., Denver, Colorado, Raleigh, North Carolina, Virginia Beach, Virginia, and Portland, Oregon. And so the reason is because homeowners that live in these markets, they have a mortgage. And so if we compare that to the housing markets like West Virginia, Mississippi, Louisiana, New Mexico, they are less impacted by lower rates because they outright own their home. Remember, 84% of existing homeowners have a rate below 6%. So lower rates are really going to be a benefit for the housing market.
And so with that in mind, and just to kind of marry the two together here, where are we seeing perhaps the more outsized impact on confidence and the sentiment right now, especially as it relates to some of these markets that Danny is breaking down here within the broader kind of landscape of where people are owning versus where they have a longer fixed mortgage?
Right, so one thing that we're seeing right now is that people think mortgage rates are going to fall further. They maybe don't feel great now that we're sitting at between a 6 and a 6.5%, depending on your source, but they expect that they will fall. And we do see that a lot of people think that if mortgage rates go down to that kind of like mid-5 place, maybe that's when they'd buy. And so the $1 million question is, when are we going to see that loosening of the lock-in effect? When are people actually going to want to come and list their homes and, really get into the market? And I think that's what Danny is kind of saying with, if you have a mortgage, maybe you're looking now, maybe it's okay to get a little bit of a higher rate now. We'll see though.
And so, Danny,
Yes.
you look like you were about to add something.
Yeah, I was. So I had talked to a couple real estate agents, and they actually described the housing market as people really hovering the market right now. So they're interested, they're looking at homes, they're enticed, but really some people say it's due to rates, and some people say home prices is also a big factor, and supply. We have to really go back to that, right? We've seen an increase in active listings, but it really just hasn't sparked too much of the interest for some buyers, because they're probably looking for something very specific and very particular when it comes to buying their home.
Interesting. All right. I'm looking for a lot of very specific things, and that's why I'm out of the market right now. No, I'm just playing. Anyway, Danny, Claire, thank you so much. Appreciate it. Turning now to an event on many consumers' minds today. Amazon Prime Day, the largest online retailer and perhaps reason that productivity is falling right now, is offering deals across the platform. But before you hit buy on your packed shopping cart, our very own Rochelle Akufo has some advice for one of our producers who's been watching these deals very closely. Rochelle.
Well, of course, as you mentioned there, Amazon's 2-day Prime Day sales kicks off today, and there are 3 elements designed to really help you part with your money, so please be aware of them. Anticipation, scarcity, and the endowment effect. So I'll break it down. First, anticipation. You will have seen ads popping up for weeks before the sale. And of course, conveniently, the Amazon Kids gift book arrived on my doorstep just in time for the holiday shopping season as my daughter waved it in my face. Reality check. Do you actually need this item to the point where buying it right now is your best and only option? So keep that in mind. Second, scarcity. You'll see that red countdown clock on the screen, adding that urgency, and even a graphic showing how many people have already scooped up that deal, say for 40% off that $100 gadget. Reality check, you're not saving, you're still spending that $60 out of this false sense of urgency. And of course, you know that Black Friday and Cyber Monday coming up in November, where you can price compare with a wider range of stores with potentially even deeper discounts. So don't feel rushed into it. And lastly, the endowment effect. Now, Amazon Prime members are already paying for the perks of having Amazon Prime, whether it's Prime Video, so they figure they may as well check out the deals that come with this as well. Reality check, just because you're already paying for the membership, don't feel compelled to spend more just because there's a sale. That's that sunk cost fallacy. I've already paid for the membership, so let me shop more to make it worthwhile. You do not have to do that.
And so what are the best ways to avoid going into debt shopping on these and during these deals days?
Well, first things first, as we mentioned there, be aware of these marketing tactics so that you don't feel that false sense of pressure to spend yourself into financial strain. And also, according to Debt.com's 2024 budgeting survey, 60% of Americans are living paycheck to paycheck. So don't feel rushed into this, and also set a specific amount of fun money into your budget every month so that when sales do come along, you can shop guilt-free and you're less likely to overspend or rely on credit cards. And remember, every dollar spent on that impulse buy is a dollar not saved for your long-term financial security. So you can build in some fun money into your budget so that you don't just, go crazy on these sales, Brad.
Rochelle, we're going to have some fun with this one as well here, because I was speaking with one of our producers who shall remain nameless for right now, who had said that some of these deals were already out there. And so how can shoppers recognize when they might be getting taken for a ride on a deal that was already in the market as well?
Well, a good thing to do, if you already had something in your cart, Amazon, especially Amazon Prime, they have this way of then they won't transfer that coupon over, so you can see what that original price was. So don't get caught up in the razzle dazzle. Do some price comparison shopping. Some of these things were already marked up and then marked down just in time for the sale. So don't chase every shiny thing. There's plenty of opportunities to buy throughout the year, but as long as you budget that fun money. And I mean, not to say that I haven't been, spending a little sprinkle here and there myself throughout the year, but I do try and budget that fun money so that I don't just sort of swipe and hit add to cart and then my money is gone.
Yeah, indeed. All right, some very valuable tips for Cheyenne. Rochelle, thank you so much. Appreciate it.
Why do you call Cheyenne out?
I didn't say who she was. Anyway, it's about to get more expensive to hit a jackpot. The price for a Mega Millions ticket will double more than double starting October 25. Yeah, wow. Increasing from $5 to $5 from $2. This is crazy. This will be the second price adjustment since the game launched more than 20 years ago. Now, Mega Millions says this is part of an overhaul of the Mega Millions game with a focus on bigger, faster growing jackpots. Quote, "We expect more billion-dollar jackpots than ever before," meaning creating more billionaires and many more millionaires as the jackpots climb. The Mega Millions has crossed the $1 billion jackpot mark 6 times. The latest was in March. A lucky winner from New Jersey won $1.28 billion. The next lottery drawing is today with an estimated jackpot of $129 million. The odds of winning are, 1 in 302.6 million. This is according to Mega Millions. Coming up, we talk to an expert about the world of travel entrepreneurship. That's next on Will. Travel continues to rebound. According to research from Get Your Guide and Earnest Analytics, U.S. consumer spending on experiences has grown 32% over the last year. That's compared to 2019 levels. So, how can entrepreneurs take advantage of this trend? Joining me now, we've got Johannes Reck, who is the CEO of Get Your Guide, a platform that connects travelers with activities and tour guides. Great to have you here with us, Johannes. So break down what you're seeing in travel spending right now and where and which types of experiences you're seeing consumers lean into.
Well, first of all, thank you so much for having me on the show, Brad. It's exciting to be here. Get Your Guide is a company that was founded 15 years ago, and we've been on a mission to unlock unforgettable experiences for travelers ever since our inception. That happened on a trip to Beijing in 2009 when I couldn't find a tour guide, and my co-founder Tao showed up in the city, and he became my tour guide and unlocked the city in a way that I could have never done by myself. And ever since then, we've seen a lot of traction in this space. Research indicates that it's a $300 billion market a year, and that's just the beginning of it. The market continues to grow, the market continues to expand, and if you add what people actually are doing on their weekends, it's a $1.7 trillion market. So it's one of these generational shifts where people spend less and less on physical goods and more on experiences. And to your question of what we're seeing in our most recent data, number one is people are turning more and more to online platforms to book experiences. The online platforms are now 2x the size of 2019, so pre-pandemic. And even more so, what we're seeing is that people are really wanting to turn to these platforms to explore their passions. And what we're seeing is that there are different behaviors across the globe. In America, for instance, Americans are really deep into social media, and they will look at multiple social media platforms, 2 to 3 social media platforms before they make a booking. So that's really where they get their validation on the experiences that they want to consume. While in Germany, where I'm sitting today, we are really value conscious. So they will look at, what's the best price. They will, look at the reviews. So we're really seeing that in the data. So there's a lot of differences in behaviors across different countries.
Johannes, just coming back to what you were mentioning a moment ago, because it's so relatable, where you get to that destination and then you start asking questions beyond what you've done in searching for, the different pins that you want to drop or locations you want to go to. You start asking questions to locals who have perhaps grown up there or lived there for a long time, and hey, what should I check out or what should I do? So for entrepreneurs that are trying to tap into that kind of social construct that takes place between locals and people who are visiting, how can they go about creating a gig out of this? And I mean, what should they charge?
Well, look, that's an amazing question. So, we've seen, suppliers and supply partners and experience creators flock our platform. And this is even more true post-pandemic than it was pre-pandemic. So this is a real movement now. And we have more than 55,000 experience creators now live on our platform. And today is actually a really important day in the life of our company, because we just launched our fall release, which features completely new features to these type of experience creators. They can now use AI to create products. So you can easily just drop in the link to your website and your entire product is created. We have insights to answer exactly that question that you just asked me on, like what's the right price point? And these insights give you a cue of whether you should add more availability or whether you should increase your price or decrease your price to be competitive in the specific segment that you're offering. But at the end of the day, my big piece of advice to all of the experience creators out there would be to go and innovate and do something new. Where we've seen the biggest success is when people come up with new creative concepts. I give you a very tangible example. In 2018-19, when Instagram really became big in travel, we had people starting to create Instagram experiences on the platform, like this famous Bali Instagram experience, which is now the #1 selling thing in Bali. And then after the pandemic, we had a lot of food-related things that came up, sports-related things that came up, maybe more neighborhood-related things that came up. So I think creativity is really the boundary of what's possible in this market.
Johannes Reck, who is the CEO of Get Your Guide. Congrats on the fall release, and we'll have to check back in the future. Thanks so much.
Thank you so much, Brett.
Certainly. Let's do a final check of the markets, everyone. We are approaching 12 noon here Eastern time and taking a look at the Dow, the S&P 500, and the NASDAQ. They're all in positive territory. The Dow leading the charge on a point and percentage basis. It's up by about 1.25%, equates to about 222 points. The Dow and the S&P 500 seeing fractional gains. That's it for Wealth. I'm Brad Smith. Thank you for watching. You can stay tuned for Market Domination with Julie Hyman and Josh Lipton coming up at 3 p.m. Eastern time. You don't want to miss it. They'll count you down to and through the market close.